inflation data, labor market data, you really need to dig under the surface to get a true sense of what the impact is.
Inflation is alive and well.
The market is pricing that inflation expectations have almost become unanchored already.
You'll still see, we think, some pass-through of higher tariffs onto prices.
Inflation might run hot well through next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, looking for the Fed to go big.
I do think we could go into a series of rate cuts here, starting with a 50 basis point rate cut in September. The rates are too constrictive. We should probably be 150, 175 basis points lower.
The Treasury Secretary, Scott Bessent, pushing for a jumbo rate cut, pushing bond yields lower and helping to send stocks to another all-time high. Next up for this market, investors looking for one more read on the U.S. economy. PPI and jobless claims up next.
Does the data warrant some of the commentary that we've heard from this administration, which does seem at odds from a number of Fed officials, even Fed officials who seem on board with the potential for rate cuts as soon as next month, have talked about how a 50 basis point rate cut, I'm thinking of Mary Daly, might not be warranted because the labor market isn't falling off a cliff. So what will it take for the jobs market, for the data to signify that the administration is correct and that the Fed is that offsides?
Typically, these kind of comments don't move markets. Typically, they don't. But they did in the last 24 hours. Why? I think they do now because they set the bar for incoming officials to the administration. You're basically effectively telling people that if you want to be on the committee, and there's a race to be on the committee right now, if you want to lead it, become the Fed chair, this is what we'd like to see.
And we've seen this in terms of who they are selecting or even considering to select to be the next Fed chair. It's been a line of people who've come on this show, other shows, to talk about how much rates should be lower. Question is, maybe people agree with that from an economic perspective. Is this the right way to go about it, to engender confidence in longer-term inflation rates and the longer-term perspective of a Fed that still has a dual mandate, yes, with the labor market, but also with inflation?
150 sounds like a lot. I think worth pointing out that 150 is essentially what is priced between now and year-end 26, 2 this year, 4 more next year. There's tons still to play for, Lisa. We both know that. We've got another payrolls report, another CPI report. We've got a guest a little bit later on this morning who's talking about a re-acceleration in the U.S. economy. The jury's still out on what's happening here.
The jury's still out with respect to how much the economy is slowing down and how much the labor market actually has slowed down. The jury is still out with how accurate the data is or isn't going forward. And the jury's still out about how inflationary some of the tariffs have already been. We've talked about the bringing forward of a lot of the orders that a lot of companies have executed in order to get ahead of tariffs. How much is that offsetting any kind of inflationary boom that we would be seeing in the data? In other words, how much is the data that we've seen predictive of what we will see in the future?
Limited pass-through so far. That can change again and rebalance in the months to come. The jury's still out. This equity market's still at all-time highs. Equity futures right now just about unchanged. Coming up this hour, we'll catch up with George Goncalves of MUFG, following back-to-back all-time highs. We'll speak to the former senior U.S. intelligence official, Norman Roule, as President Trump sends a warning to Russia. And Aditya, Bhave, Bank of America, as Secretary Bessent urges the Fed to cut rates. And Bank of America has a warning, not so fast. We begin this hour with stock steady as traders await a fresh round of economic data. George Goncalves of MUFG writing, with CPI a virtual non-event, we either drift from here or we're greeted by some kind of exogenous event that shakes markets out of this complacent and sanguine slumber. George joins us now for more. George, good morning.
Good morning.
Complacent. What makes it complacent?
This steady grind, this buy the dip, this no questioning the price action, steady as it goes. Look, your guys' intro was fantastic. This is a interesting time inflection point, right? We're at a point where there's potential for upside. There's a lot of uncertainty. Potential uncertainty has been cleared up. I'm much more in the camp that we should not suggest that tariffs are priced in, because we just don't know. This idea that we know how to kind of compartmentalize tariffs, but the pass through to pricing, how much of it was pulled forward activity, how much of it is just kind of a price rigidities around contracts where people can't move up prices. There's a lot that could still happen on the inflation front that's ahead of us. So let's not get ahead of ourselves here. But I think in the very immediate near term, it's August, right? It's August. We got 2 more data points with PPI, retail sales, and really Jackson Hole next week, right? That's going to really set the stage until Labor Day when we get back, and then the fireworks, I think, start.
Lisa mentioned it, you echoed it. We're working through this pre-tariff inventory. There is some evidence that companies are absorbing it. Could be for now, might change in the future. Is Jackson Hole too soon? Is mid-September too soon to draw conclusions?
Look, there's a lot of deja vu to this summer, to last summer, but for different factors. Even you're seeing it in the way the technical setups of the stock market. You're even seeing it in the 2-year Treasury. We're basically flirting with the near-term lows that were very similar in the low, upper to high 360s.
367 this morning.
Very similar to what it was like heading into September 2024 when the Fed delivered 50 basis points, right? So, and we're obviously hearing a lot of clamoring for 50 basis points. Just as a reminder, we were one of the few houses last year that called for 50, but for the right reasons. And I think this time it's not as clear because of the inflation outlook. And we have been of the view that the jobs market has been overestimating for quite some time. So I think the jobs market data does warrant further cuts, but at magnitudes of 50, things have to get progressively worse from here.
I'm glad that you talked about the labor market. The mandate, the dual mandate is the inflation side, which we've discussed. How much are we actually able to predict any kind of inflationary boom going forward? But then also demographics and whether we're measuring the labor market correctly. And of course, there's been a lot of focus on that with the BLS. This symposium's theme is labor markets in transition to demographics, productivity, and macroeconomic policy. How much could they shift the conversation in discussing a new way of measuring just how strong this labor market is?
Look, I think there's going to be an attempt at that. There's going to be an attempt at also reconciling what, productivity AI, really, it's all about AI on a go-forward basis. Is that deterring companies from hiring? Is that truly showing up in the numbers, or is that more of an excuse? So I think the Fed will be trying to get their arms around what's happening on the productivity front, and are we getting more with less workers?
Some people have pointed to the fact that you haven't seen longer-term yields absolutely spike. You have seen yield curve steepening, but you haven't seen some sort of response from a market that's pricing in more front-end cuts by necessarily selling off in mass function the long end of the yield curve. Does that comfort you? Does that give you a sense that maybe this is the appropriate policy, maybe if for the wrong reasons?
Look, I think we've been stuck in the range largely because there's a tension in the long-term sector between those that are much more concerned about the fiscal outlook, those that are worried about inflation expectations getting unhinged, that magnetizes and tries to pull up rates. But it hasn't worked. We've had basically the 10-year trading between 4 and 450, better part for the longest time. We're at now sub 425. If the Fed does cut rates in a much more sharper fashion in larger increments, this time, unlike last year, I think all rates will rally, including the 10-year. And I think that's what the 10-year is picking up on. I know it sounds like counterproductive to this idea that the Fed's cutting into a potentially higher inflationary environment. If they cut by 50, it's because the labor market's gotten even worse, right? So I think the NFP crystallized this fear about what the data is, what it's really telling us, and if the Fed starts cutting that fast after being in wait-and-see mode and holding off this long, that means that they're behind the curve, right?
You're very precise with your words. You said the 10-year repeatedly. What about further out along the curve, the 30-year?
Yeah, a 30-year, I think, really being driven by the supply-demand globally. Also, what's happening in the UK market, the Japanese.
This is what the Treasury Secretary talked about just yesterday.
Yes.
Almost sort of outsourcing borrowing costs to Japan, to the UK, to what happens in Europe. And we asked pretty directly, what's the incentive to carry on issuing a 30-year here? And he responded by putting pressure on the BOJ and Japanese authorities to hike interest rates. Now, it's pretty rare to have a Treasury Secretary come out and tell a foreign central bank what they should be doing right now. What did you make of that?
No, I do think that there is credence to it, though. I mean, there is this, because the bond market is a fungible global bond market where investors and capital will go to the highest yields and most liquidity. And there's a large segment of foreign investors that over the years bought longer-term treasuries because they were the only yield in town. And now that's not the case.
Yeah, but what do you make of this in particular? It's pretty untraditional for a Treasury Secretary to talk about really what the Federal Reserve should do, let alone the Bank of Japan. It's somewhat not unprecedented, but really breaking with tradition. What does it tell you about how reliant the U.S. Treasury market is on foreign dynamics that are outside the Fed's control? In other words, even if they cut basis points, if they cut rates by 50 basis points in response to weakness, the long end is tethered to something far out of their ability to really to dominate.
Yes and no. I would say because of the inflation expectations channel, and that's both, you're hearing it from the BOJ and from the Fed, that they're worried about inflation expectations, potentially getting unanchored or staying higher than historical averages. I think it is all about, central bank. Look, I've always viewed the Fed as the global central bank. The dollar's still supreme, and that still drives flows, capital flows around the world. But other central banks play a role also in trying to make sure that we don't get this sort of inflation impulse more broadly outside the U.S. and feeding back into long-term rates and then wash, rinse, and repeat.
So given the fact that you think that if the Fed cuts rates by 50 basis points, it brings down all denominations, or 10 years, maybe not 30 years, as John pointed out, why aren't you bullish? Why aren't you saying this isn't complacency at all? This is absolutely a justified creeping higher in equity markets with a Fed that's well in a position to offset any weakness?
My concern is all about the execution timing, and a lot of it is priced in. I mean, the bond market is too smart for its own good. After the NFP, basically, it priced in 30 basis points in one day. I mean, you're Anna Wong, economist who does really good work. We should have moved like 10, 15 basis points. We moved 30. Like that, for the market supposed to be so liquid, why did it move like double the speed it should have moved?
We're back to post-NFP levels this morning on a 2-year, back to 367.
Too smart for its own good, just
apparently
too quick to really understand.
So those bond traders.
Yeah, exactly.
I think what we're hearing here is they're the smart ones, and then maybe on the equity side. You got something to say? Maybe on the equity side?
Really?
What
you trying to start something?
No, I'm sorry.
Okay,
he
go
teed
ahead.
it up.
All right.
Look, I think at the end of the day, what this comes down to is, like, do you ignore macro or do you not ignore macro? The bond people never ignore macro, and sometimes equities do.
You've been in this a while. Diplomatic. Thank you, sir. George Goncalves there of MUFG. More all-time highs on the S&P 500. It is rare to hear that from a Treasury Secretary, but he is somewhat uniquely qualified to talk about global bond markets. That's the issue. I think it's very compromising, though. This really compromises the BOJ now. What happens if they come out and say, yeah, sure, we'll start hiking? And people just say, are you being told by US authorities to do this? Is that why you're doing this?
Some people are saying this actually will make it harder for them to hike rates in the near term. There's also a question about whether this really underscores the weak dollar policy. Is this a U.S. administration that wants a weaker dollar for the rest of the year in order to juice some of the competitive advantage that U.S. companies have?
Yen stronger this morning. Dollar yen down to 146.62, a move of about 0.5%. That's the price action. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yohara Arnold. Hey, Yohara.
Hi, John. Sticking with the BOJ, the Japanese yen is strengthening against the dollar this morning, while JGB yields are ticking higher as traders woke up to Treasury Secretary Scott Bessent's comments. The BOJ is behind the curve. Bessent telling us you on surveillance yesterday, the Japanese central bank needs to get their inflation problem under control. Meanwhile, President Donald Trump warned he would impose very severe consequences if Vladimir Putin does not agree to a ceasefire with Ukraine. Trump is set to meet with Putin tomorrow in Anchorage, Alaska. He said he hoped to use the meeting to set up a quick second meeting with Putin and Ukraine President Volodymyr Zelensky. And we're learning more on how Apple is trying to prioritize AI. Sources telling us here at Bloomberg, the company is working on a slate of new devices, including robots, a lifelike Siri, and home security cameras. In addition to the home devices, Apple is preparing thinner and redesigned iPhones for release this year. It also hopes to introduce smart glasses and a 20-year anniversary iPhone. That's your Bloomberg brief. John?
Yohara, thank you. More from Yohara later this hour. Up next on the program, President Trump sends a warning.
Will Russia face any consequences if Vladimir Putin does not agree to stop the war after your meeting on Friday?
Yes, they will. Yeah.
What will those consequences
There will be consequences.
Sanctions, tariffs?
There will be very severe consequences.
That conversation up next with the former senior U.S. intelligence official Norman Roule. Live from New York City this morning. Good morning. This is a market hungry for more economic data. Later this morning, it'll get it, 8:30 Eastern Time. A read on inflation with PPI, a read on the jobs market. Look out for jobless claims at 8:30 Eastern later on this morning, about 2 hours away. In the equity market, slightly negative, pulling back from 2 days of gains on the S&P 500, down by not even 0.1% on the S&P. On the Nasdaq 100, negative by just 0.08%. Under surveillance this morning, President Trump sends a warning.
Will Russia face any consequences if Vladimir Putin does not agree to stop the war after your meeting on Friday?
Yes, they will. Yeah.
What will the consequences
There will be
be?
consequences.
Sanctions, tariffs?
There will be very severe consequences. I would say the second meeting, if the first one goes okay, we'll have a quick second one. I would like to do it almost immediately, and we'll have a quick second meeting between President Putin and President Zelensky.
It's the latest this morning. President Trump issuing a warning to Russian President Vladimir Putin following a call with European leaders. Trump threatening, quote, very severe consequences if Putin does not agree to a ceasefire in Ukraine. Bloomberg's Pierre Skolimowski joins us now for more. Pierre, welcome to the programme, sir. The president had a call with European leaders. I believe he called it a 10. What's your understanding of what was discussed on that call?
Hi. So indeed, the call happened and Europeans came out of this cautiously optimistic. So what they heard from Trump officially and unofficially during the call, or what we heard from our sources and also the leaders as they spoke afterwards, is that, first of all, they obviously were keen to hear this warning about very severe consequences against Russia, which probably means secondary sanctions of some kind or tariffs. But also what was important is that they heard that Trump he told Europeans that he wants to focus on getting ceasefire done. That's the first thing during the meeting with Putin. And obviously he spoke about a quick trilateral summit that would also involve Zelensky. He also sort of downplayed expectations for a full peace deal just being done with Putin on that during that meeting in Alaska. So you know, the one important thing that Europeans were keen to hear is that apparently Trump basically said he gave them assurances that he's not going to negotiate territories with Putin, which was something that really caused a lot of serious alarm among European leaders, also with Zelensky, because obviously not being at the table there and discussion about the so-called land swaps was a serious concern. So overall, positive take, but obviously anything can happen. Trump is the previous talks between Putin and Trump went different directions. So, they're all waiting for that one.
I imagine this is something European leaders are still nervous about. Pierre, thank you, sir. At least there is some talk of a joint news conference between the two leaders, so we could see some real fireworks over the weekend.
Especially depending on how it is received by the Europeans. A real question, is President Trump downplaying it, or is he looking for a ceasefire with actual conditions? What does that look like, given the red line that has been drawn?
To build on that conversation, the former senior US intelligence official Norman Roule joins us now for more. Norman, welcome back to the programme, sir. Is the president in a position to negotiate on behalf of the Ukrainians?
Good morning. He is not in position to negotiate on behalf of the Ukrainians. The Ukrainian president has made that clear, and the Europeans have done everything they can to send a unified message that Ukrainian territory is not something the president can offer in his talks. And in fairness, the president has stated that he is not going to offer Ukrainian territory to the Russians, and indeed will be doing what he can to acquire Ukrainian territory that Russia has occupied to return back to Ukraine itself. The question is, how exactly does he do this? And indeed, in terms of the severe consequences that he would apply to Russia, that in itself requires some caution, because to do that requires secondary sanctions on China and India. And as Secretary Bessent has stated, that would require European cooperation. And Europe has not been very enthusiastic about cooperation in that regard in the past.
Norman, there's a lot to unpack there. I want to get into the ceasefire agreement that President Trump has talked about as a threshold to cross in this meeting tomorrow. What would that look like given the previous ceasefire agreements that already have been made and broken?
A ceasefire agreement is unlikely. President Putin has violated most of those agreements, and right now we're watching each side do what they can to demonstrate strength. The Russians are conducting a series of ground operations that are allowing them to make short, sharp advances in the Donbass. The Ukrainians are conducting drone attacks on Russian energy facilities, which are important given that Russia's economy is contracting further, per the IMF. We'll have only 0.9% GDP growth this year. So we're unlikely to see a ceasefire take place unless each side is convinced that a peace deal is likely. And again, we have no evidence for this in the near term. This said, the president is going to be doing his best to achieve that. And we're likely to see one-on-one meetings with President Putin and President Trump. The Europeans will be concerned about that. They have demonstrated that concern, and the president has demonstrated in the past that his relationship with Putin is very personal, and he sees that personal relationship as where his strength lies in achieving an agreement.
There's a question, Norman, about whether the president really has as much leverage as he could if he's going into this without the Europeans agreeing to helping to enforce the secondary sanctions. Do you think that this is premature? Do you think that this is a good timing on the part of President Trump to go at this alone, given the lack of cooperation on some of the more punitive parts?
Well, to be clear, I'm not sure that the Europeans are ever going to be enthusiastic about supporting secondary sanctions on China and India. And at the same time, Russia's Russia's economy continues to contract. It has contracted. The IMF has reduced its projections for GDP from 1.5% to 0.9% for this year and next year. 40% of Russia's economy is now devoted to military spending. It's likely to remain that way for the future. And Russia is losing a vast amount of personnel every day. The president sees this. I would expect that his private intelligence and economic briefings show a dire picture for the Russian economy. And he probably sees this as his lever over Vladimir Putin. So although Putin will come in playing a strong hand, trying to show battlefield gains, trying to show that he's going to win this war, I think the president's position is going to be, look, you're a big country, an aging population, you've got great resources, you could be doing great things in the world, but you're driving your country into the ground, and the best way for you to save your country's future is to end this conflict. I think that's probably going to be the tactic the president may consider.
Norm, do you think that tactic will work?
I doubt it. I think Vladimir Putin is a map changer. He is committed to changing the role of Russia, to restoring the Russian Empire, the Soviet Empire. He doesn't believe Ukraine should exist as a country. I think he's committed to the maximalist gains. He may offer some sort of territorial concessions to restrain sanctions. He may try to delay further sanctions. We also have arms talks that Vladimir Putin may hold out. And nuclear talks are something that we no longer raise in our discussions, but are tremendously important. And I think Vladimir Putin may hold out nuclear talks and Arctic cooperation as some way to continue engagement with the U.S. That may complicate the relationship. And again, you don't hear nuclear talks and Arctic cooperation as something of great importance for Europe, but they are of importance to the United States for our national security.
Norm, what I hear from you is this doesn't end without compromising the integrity of Ukrainian territory. Now, I just wonder, with that in mind, Norm, how you think this does end, or will it end? And if this can just continue for years on end?
This ends when the Ukrainians decide it ends. That's not a decision the American government can make. This ends when the Russians decide it ends. Again, that's not a decision the Americans can necessarily make. But at a certain point, any deal that does come about in the end is probably going to leave each side unhappy. And the U.S. government has communicated on a number of occasions that if there are going to be territorial decisions made in the end as part of a peace agreement, it probably would involve concessions on each side that will leave each side unhappy. That's a tough thing to say. And obviously Ukrainians who have given blood are going to be unhappy to hear that. But that has been a previously stated U.S. position. But again, that's a Ukrainian decision to make. And it's not a decision they're going to make at present. And it's a decision they won't make unless they're at the table.
Norm, thank you, sir. Appreciate your thoughts. The former senior U.S. intelligence official Norman Roule with some sobering words there on the future of that war. Up next, Bloomberg trade czar Brendan Murray as the White House sets up a new model for U.S. sales to China. Back-to-back all-time highs on the S&P 500 in yesterday's session, just about squeezing out a second day of gains on a benchmark stateside. This morning, pulling back slightly. We're down by almost 1/10% on the S&P. On the Nasdaq 100, down by 0.08, call it 0.09. We've seen this outperformance in the Russell recently. Small caps starting to perform. This morning, just a little bit softer. We'll come back to that story later. We're down by 0.3%. If you switch up the board and turn to the bond market, the whole curve yesterday, 2s out to 30, shifting lower as we start to lock in rate cuts starting in September. We're back down to the post-payrolls lows. We're at 367 at the front end of the curve. At the longer end of the curve, the 10-year maturity played a part as well. It's down another 2 this morning. We're back down to 421.
And George Goncalves said that this time around, if the Fed were to cut by 50 basis points next month, that would actually pull the whole yield curve lower versus what we saw last year when the Fed cut by 100 basis points. The long end of the yield curve sold off. Yields went higher, not lower. Why? Because there is real weakness in the labor market that the 50 basis point cut would be in response to, which may be the reason why Fed officials might not want to go 50 because it would send that signal.
Nailed it. You're going 50 for all the wrong reasons. You're going 50 because you're going to see a repeat of the payrolls data from 2 Fridays ago in early September. That's the last thing you want to see. This Fed go 50 because payrolls are falling apart.
Which raises a question, is that actually a reason for equities to rally if the Fed is cutting for being behind the curve and the labor market already seeing a greater degree of deterioration?
You know, Lisa, I'm pleased you bring that up because I wonder if the inflation data was a reason for the equity market to rally either. If you think about what all the economists said on Wall Street, they all said the same thing. This is evidence of companies eating it on margin. The Treasury Secretary yesterday said this about that. He said there were some margins that got very fat during COVID, and we've seen a return to pre-COVID margins. Is that a good story for parts of this equity market? Maybe away from tech, but for the rest of the stock market, it doesn't scream a great story.
If you're a stock investor, you want those margins to stay fat because ultimately it's going to come out of your bottom line. You hear the likes of Alpha Beauty talking about $50 million on an annualized basis. Caterpillar, the impact being about $350 million. Colgate, $75 million. Kimberly-Clark, you could just go down the list. I was gathering a list yesterday. And there's a real question here. Have people adequately appreciated that hit to their bottom line if they are holding the equity of those companies?
Equities this morning still doing okay, just about unchanged on the S&P 500 with 3 hours away from the opening bell. Let's get you some morning movers and cross over to Danny Berger. Hey, Danny.
Hey, John. Well, the animal spirits are back. IPOs are back, at least when it comes to crypto companies. The crypto exchange Bullish, debuting yesterday to an 84% gain. It doubled its price at various points of its IPO price. Here we have another gain pre-market. Shares are up just under 16%. It also probably helped them that yesterday coincided with another all-time high in Bitcoin, largely driven by the adoption of Bitcoin by so-called Bitcoin treasury companies, which, by the way, Bullish is one. So again, those shares continue higher. Now, to the downside this morning, we had Cisco earnings yesterday, which provides a lot of AI services. And this is the thing that we keep seeing with companies. They gave a forecast and it was in line, and inline wasn't good enough. So shares are down 1.1%, but otherwise they said that the demand for, again, their AI services were really strong. They also said that they see government spending on their resources coming back to growth in this next fiscal year, despite some of the weakness more recently in those Trump-driven cuts to the federal government. Finally, rounding things out with Birkenstocks, you guys were just talking about the idea that companies are taking a hit to their margin. Here is a company that is not. They were outright talking about on their earnings the fact that they are raising prices. They have to do so because Birkenstocks are made in Germany. But Williams Trading, for example, calling this one of the hot brands. So if you're a hot brand, apparently you can raise prices. They said prices were higher by in the mid-single-digit percentage points to account for tariffs. So those shares go up 2%, John.
I like to be optimistic, Danny, to have faith in humanity. Got a lot of faith in humanity. Maybe it's misplaced, I don't know. But when I see Birkenstock, I start to wonder. Pricing power over at Birkenstock.
Oh, my goodness.
Hey?
You obviously have never had a pair.
Questioning my faith in humanity.
You obviously just don't appreciate the style. That doesn't mean that other people cannot appreciate the style. It's very convenient. A lot of people wear them with socks.
That's the thing that kills me.
And I knew that you were going to. I think it would look good on you. I think that skinny pants that just
visually
end
offensive.
right under the knee. And
visually
then,
offensive.
Not so much. Not going to see that in John's land anytime soon.
Absolutely not.
I knew you were thinking
You'll
this.
never see me looking like that.
Good for Birkenstock.
Good for them. And our radar this morning, President Trump sending a warning to the Russian President Vladimir Putin ahead of their meeting tomorrow, saying he will impose very severe consequences if Putin doesn't agree to a ceasefire agreement with Ukraine.
So there are a lot of questions here. And we were talking to Norman Roule just moments ago, and he was talking about how he doesn't see it likely that there would be a ceasefire agreement simply because there has been one in the past and it's been broken in short order. A question here, how serious the red lines are, how much they haven't really been implemented yet. And then from a market consequence standpoint, has the market priced in some sort of easing in tensions with oil prices coming down? And could that reverse if you don't get any deliverables from this meeting?
Hearing from Norman Roule, it's going to be very hard to deliver anything. What we just heard from Norman Roule, former senior US intelligence official, basically came on the programme 5 minutes ago and said you don't get a deal without questioning the integrity of the territory of Ukraine. Now, I don't see how you make that deal with that in mind. And I also wonder what the president can actually say to Vladimir Putin at this point. I don't know what the carrot could be beyond some small trade issues. What can the carrot be when you don't seem to have the Ukrainian president alongside you on what you can offer over the weekend?
I spent a lot of time over the past few months listening to Peter the Great. This episode, a series of episodes on The Rest is History, a great podcast, by the way. I'm just going to put that plug in. It's British. You'll like it. But talking about sort of this knee-jerk want to gain land and this belief in sort of the autonomy, but also this sort of police state of Russia that Vladimir Putin is trying to replicate. And it doesn't seem like this is something that can be agreed to very easily.
Annmarie on the road today, so you'll see AMH covering this meeting over the weekend in Alaska. So look out for headlines from the team here at Bloomberg. I want to turn to the latest from the Federal Reserve. The Atlanta Fed President Raphael Bostic saying he still expects one rate cut this year if the labour market stays solid. Chicago Fed President Austin Goolsbee also speaking yesterday, saying the central bank's meetings this fall will be live. A range of speakers in the last 24 hours, including Mary Daly of the San Francisco Fed, to the Journal.
Yeah, she was speaking to the Journal in an interview where she said she doesn't see the need to go by 50 basis points, so that would actually send the wrong message to markets, that there would be a need, and that the Federal Reserve was far behind the curve. She doesn't see it that way. How she does see it is that any kind of move seems to be in the wrong direction with respect to deterioration in the labor market, and that she supports some sort of gradual easing back to neutral, which a lot of people think is around 3.5%. It is a very different message than the one being put forward by Scott Bessent.
I don't see a path for the Federal Reserve to come out of 2025 looking good. And I'll give you an example as to why. Let's go with the margin story at corporate America right now. That can break two ways. Either they're going to pass it on to consumers, or at some point they start thinking about how to manage costs. How do you manage costs? You start pulling back on labour. So you get to September and you've got to decide what is the lesser evil here. If we see a dual mandate in conflict, there's no winning for this Federal Reserve. You've got to pick one. And then you get blamed for missing the other one.
And end up with something that could look like an inflationary expectation that starts building if you do cut too much, or a labor market that deteriorates. They can't look good anyway because they have a president who keeps jawboning them and bringing people in who will change the way they do things. So I don't think looking good is their priority here. Getting it right, though, is a real question. How do you get it right at such a precarious and unknown moment?
Looking credible seems to be the ultimate objective of this Federal Reserve at the moment. The Treasury Secretary, Scott Bessent, also had some things to say about the Bank of Japan falling behind the curve on inflation, adding that he expects the central bank to hike interest rates. His comments coming as the BOJ continues to have one of the lowest policy rates among major economies. This matters, not just for borrowing costs in Japan, but for borrowing costs elsewhere.
Japanese buyers were some of the biggest buyer base for U.S. Treasuries and, frankly, investment-grade bonds for a very long time because there was no competition at home. If they put their money in Japanese government bonds, they would lose money. It was not a market. So they came to the United States. If you have higher yields in Japan, that will keep them there, but it also will mean that yields will be higher here because ultimately that means that you don't have the buyers in the United States. It is a competitive international landscape. I do wonder, though, what is Scott Bessent's motivation in talking about this with you and Annmarie yesterday? Is it to get them to raise rates? Because if that's the case, it kind of compromises them. Is it to get the dollar weaker? Or is it just to sort of give a nod to the fact that the Fed doesn't have full control over global bond yields?
Well, I concede I brought it up. So let's talk about what I brought up. The reason I brought this up is that ultimately you've seen some leakage at the very long end of the curve. And at the very long end of the curve, we've seen high yields, not just because of what's happened domestically in America, but I think more so what's happening internationally. In Europe, in places like Germany, where they're issuing more debt to try and stimulate the economy. In the UK, when they've got their own problems. And in places like Japan, where they've failed to put a lid on inflation. And I think that's why you're starting to see the Treasury Secretary engage with the question just a little bit more, because he understands there's some issues here domestically that are out of our control that maybe foreign officials can do something about, and maybe they will in the coming months.
Well, and it also raises a question of how much the U.S. is going to be stuck with higher inflation because of the global inflation picture, not just the United States. It is, though, ironic because in the United States, we're cheering a CPI print that comes in at 2.7% as sort of achieving the perspective that we were looking for and causing the Fed to be able to cut rates by 150 basis points. And yet the mandate, I do believe the target is still 2% for the Federal Reserve.
The words of the Treasury Secretary moving the FX market, dollar yen down to 146.47. Let's stick with that conversation with Secretary Bessent, the White House testing a new model for U.S. sales to China.
This is a very unique solution, allows NVIDIA to expand into China. It can make NVIDIA chips the bellwether for Chinese technology, and then the U.S. taxpayer gets a share of that. We could see it in other industries over time. I think, right now, this is unique, but now that we have the model and the beta test, why not expand it?
Joining us now to discuss is Bloomberg's Brendan Murray. Brendan, welcome to the programme. This is a very unique situation. And then he goes on to say it might not be very unique in the future. Brendan, how could this change global trade and the interaction between US companies and foreign markets?
Yeah, I think this speaks to a couple of things. The first being that President Trump is, if you will, making some of this stuff as he goes along. Secretary Bessent credited the president with coming up with this idea, this 15% for NVIDIA. And it seems that the second reason is basically the president really wants to do a deal with Xi Jinping. And he's throwing them this concession to say, you want some of our advanced chips, we'll give you some. They're not the most advanced, but we'll meet you on one of your demands. And the third reason is, as Bessent said, that they really need the revenue. These tariffs are under court scrutiny at the moment. It's not clear that they will survive past the court decision. It's probably going to go to the Supreme Court. So they need this revenue, and they're going to try to get it any way they can.
You said that they need this revenue because of the court challenges. How much do you think that that's actually a part of this, to keep some sort of money coming in, even if there is some sort of court injunction on the existing tariffs?
Yeah, I mean, I think it just fits with the pattern of President Trump. Anywhere he sees a company or constituency that really wants something, he sees a revenue opportunity, and so you can say the same thing about the so-called reciprocal tariffs. He says, everybody wants a piece of the American consumer. You're going to have to pay up for it. So I just think he's using that sort of business acumen to do it. And, we've seen his goal of reshoring. We saw a big manufacturer, GE Appliances, announce a big investment in the U.S. yesterday. But it also happens to be a Chinese-owned company that's investing. And so there are some trade-offs that the administration is going to have to make.
And Brendan, just finally, you're sitting in London. What's the UK's response to this? What are the Europeans doing about all of this as they look at this play out and see these innovative ways of coming up with new ways to raise money? How are they thinking about this situation?
Well, I would say, to Secretary Bessent's point about Japan, the Bank of Japan being behind the curve, I would imagine that some Japanese officials would say that the Trump administration is behind the curve on delivering the actual fine print of these deals that they're trying to negotiate. The UK still doesn't have clarity on steel. The EU is still waiting for the actual executive order to carry out the 15% auto tariffs that it was promised. At the moment it's paying the 25% still. Same with Japan, same with Korea. So these countries that think that they got a deal with the administration are paying those higher sectoral tariffs at the moment and waiting for the follow-up from those negotiations that took place 2 or 3 weeks ago.
Interesting final point, Brendan. We've got to leave it there. Appreciate your time. Brendan Murray there on trade and the effort to do a whole lot more to raise money here in the United States.
How do you get clarity if you're a trading partner, if this is a type of bespoke deal? Wasn't this supposed to be a national security issue? Where does national security begin and raising revenue pick up?
It's not a national security issue anymore, we were told yesterday, just to confirm.
Well, I guess some people say the H20 chip is 5 years behind where you are in terms of the B200 or whatever the latest chip is that people are selling in the United States. That said, it sort of is a fungible measure that we're looking at to really understand what's allowed and what isn't.
To your point, we're certainly blurring the lines pretty quickly on this side of the world. Equity futures on the S&P, if you're just tuning in, we're doing okay. Back-to-back all-time highs on the S&P 500, just a little bit softer, negative by 0.06% on the S&P. With a look at our top stories worldwide with our Bloomberg brief, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. The UK economy grew at a faster pace than expected in the second quarter. GDP rose 0.3% in the 3 months ending in June, maintaining positive growth for the third straight quarter. That growth was led by services, while construction also increased, but production did fall slightly. Meanwhile, Treasury Secretary Scott Bessent has been granted an extension to fully divest all his assets in compliance with an ethics agreement. Bessent said the remaining assets represent 4% of his required divestitures and that much of them are farmland. According to documents reviewed by Bloomberg, Bessent was given until December 15th to complete the divestiture. And Deere shares are falling nearly 6% in the pre-market after the tractor maker trimmed its full-year outlook. The results indicate that farmers are holding back on spending with grain prices under pressure. The sector has been expected to bottom out this year, but uncertain crop demand amid President Trump's trade wars is throwing that timeline into question. That's your Bloomberg brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes' time. Up next on the program, looking for the Fed to go big.
I do think we could go into a series of rate cuts here, starting with a 50 basis point rate cut in September. The rates are too constrictive. We should probably be 150, 175 basis points lower.
That conversation up next with Aditya Bhave of Bank of America, live from New York City. This is Bloomberg. Check out the market. All-time highs at a close yesterday. Futures pulling back, not even 0.1%. No drama there. That's the stock market. In the bond market, the two-year yield at the lowest level since the end of April, down for 3 consecutive days. We're back to 367 at the front end of the curve. Under surveillance this morning, looking for the Fed to go big.
We could have had rate cuts in June and July. So that tells me that there's a very good chance of a 50 basis point rate cut. I do think we could go into a series of rate cuts here, starting with a 50 basis point rate cut in September. The rates are too constrictive. If you look at any model, that we should probably be 150, 175 basis points lower.
Here's the latest this morning. The Treasury Secretary Scott Bessent making the case for a jumbo rate cut next month. Aditya Bhave, Bank of America, doesn't agree, writing markets are pricing almost a 90% chance of a 25 basis point cut in September. But we aren't yet convinced, in part because we think the economy might be re-accelerating. Aditya joins us now for more. Aditya, good morning.
Thanks for having me.
You've got a good story to tell about this US economy, so let's spend some time on it. Why do you believe we could be seeing a re-acceleration in the months to come?
Well, it's partly what we're seeing in our internal card data. So we look for a pretty solid retail sales print tomorrow, slightly above consensus. And what we learned on Tuesday is that that won't be largely because of tariffs, as it was in June, right? So you'll see a pickup in real spending. You're seeing strong auto sales for July. Air travel really picked up in July, and it's continued into August. And our card data have actually accelerated in the first 2 weeks of August. So there's a few things going on there that suggest that at least the consumer is picking up here.
And this is one reason why people shrugged off the higher than expected core CPI that we got on Tuesday, because it was largely due to airfares. People are flying more and prices are going up, and people said that's a very volatile indicator. Can this be expansion without inflation? Can this be acceleration without some sort of material price shock that does continue?
There doesn't need to be a huge pickup in inflation, but the point that we've been making is that even X of the tariff shock, we can debate the tariff shock endlessly, but even X of that, I think the core PCE, headline PCE, probably stuck around 2.5%. And that's the concern that we have for Fed policy. We think they're meaningfully away from target and even further away in the other direction than they were before the pandemic, when they were obviously very concerned about the undershoot.
Is that wrong? I mean, is this maybe the appropriate inflation rate that we should be targeting? Is 2.5%? And shouldn't the Fed maybe allow that to be the case if that means a healthy labor market and an economy that keeps on going?
That's reasonable, but then they'd lose credibility around their 2% target. So if they want to change their target, that's fine. I think it's a little bit dangerous to change your target when you haven't hit the target yet, because then it becomes a slippery slope. But if they do that, then we'll adjust our forecasts accordingly.
That's your take on inflation. I want to build on your take on the labour market. Yep. We've seen a real step down in payrolls growth. Have we seen a move in slack? Have we increased slack with that step down in payrolls growth? Because I think that's the more important question for this Federal Reserve.
That's what's really interesting, and I think the answer is not entirely obvious. The unemployment rate has been range-bound for a year. The ratio of vacancies to unemployed workers has basically been range-bound for a year. So it is possible that a lot of this slowdown is because of labor supply rather than labor demand. And consistent with this idea, what you're seeing in wage inflation, total income growth is actually quite solid. And that's really important. Because what happens typically in a downturn is that you get this snowballing between job losses and therefore lower income growth, and then slower consumer spending. But if income growth's holding up, then you might not get that knock-on effect on job losses.
Do you think we're confusing a cyclical term with a structural shift then? Is that ultimately the source of confusion at the moment?
Yes, and that's what can happen with supply shocks. We're being hit by so many supply shocks right now that it makes forecasting very difficult. And we think folks like, let's say, Governor Waller are not putting enough focus on the labor supply shock. So the slowdown in the labor market could just be a supply story, and as you say, slack hasn't really increased.
It's very hard to understand this labor market. It's even harder when there are questions about the integrity of the data in terms of just the responses to surveys and recently the firing of the head of the BLS, the Bureau of Labor Statistics. What are you looking at in terms of secondary and tertiary sources of data to fortify your view in absence maybe of said labor market report that we get every month?
Right. So on the labor market, you could look at jobless claims. I think that's a super useful indicator. You could look at you could even look at just consumer spending data, right? Again, going back to our BAC card data, you see that live, and it's very unlikely that folks are going to keep spending on discretionary activities if the labor market is holding up. And then you could also look at ADP.
Typically, it would be hard to make an argument that the economy has fallen off a cliff with jobless claims expected to come in at 225 later on this morning. 225, historically, exceptionally low.
This is the sort of surprising aspect of this. When people look at jobless claims, it's supposed to be the most real-time indicator, and yet it's been basically range-bound or flat for a number of years now.
With an expanding labor market. So we've been looking at the level of jobless claims and comparing that to where they were, 10, 20 years ago. But if you scale that to the labor market, claims are actually extraordinarily low. There are some structural reasons for that. Folks are doing gig jobs instead of applying for claims. But that's actually good for the labor market, right? It's good for the economy.
Aditya, appreciate your take. Constructive view on the US economy. Aditya Bhave there of Bank of America. Still looking, I believe, for no cuts this year. Is that right?
That's right.
No cuts for 2025 and looking for a step up in economic activity.
Yeah, for all the right reasons, to your point that you just said there, that essentially the economy is doing just fine, in his view, going forward, even with rates where they are. So this is the competing view. Can you have an economy that's doing just fine and still justify 50 to 75 basis points of rate cuts like the market is expecting? Or is there a dissonance that's not getting priced in either with respect to the rates picture or the equities picture?
The market wants its cake and wants to eat it too, basically, right? Wants the rate cuts that come with the kind of deceleration in the economy that is usually associated with a market that's not doing well.
This administration wants its cake. It wants to eat it too. And so the question is, will policymakers agree with the economic rationale behind that?
Equities doing all right this morning, just about unchanged on the S&P, slightly softer. Up next, we'll catch up with Ed Yardeni of Yardeni Research. We'll speak to Ed Mills of Raymond James, the former World Bank president, David Malpass, and Sonal Desai of Franklin Templeton. The second hour of Bloomberg Surveillance. Up next.
What we've got is a tortoise of an economy and a hare of a market.
There's a lot of optimism baked in.
Global equity markets are overvalued.
It's all about large caps and tech.
If the market continues to do well and momentum is on the market side, I think the pain trade is still probably higher.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now. In your equity market, your scores look like this. We're down by 0.1% on the S&P, following back-to-back all-time highs on the benchmark stateside. On the Nasdaq, we're down about 0.1% also. A series of days now, too. Outperformance on the Russell. The small caps making a comeback. We're down 0.3% this morning. In the bond market, switch on the board. 2-year, 10-year, 30-year. Focus on the front end of the curve. 2-year yields back to levels we have not seen since late April. 366.79. We're down another, let's call it a basis point this morning as we start to lock in some rate cuts.
Yeah, on the heels of the conversation that you and Annmarie had yesterday with Scott Bessent, Treasury Secretary, calling for a 50 basis point rate cut next month, followed by additional rate cuts down 150 to 175 basis points below where we are currently for the Fed funds rate, raises a question. Is the Treasury Department, Scott Bessent, someone who has known the markets for a very long time, seeing something in the labor market that really is concerning and prompts the Fed to play catch up? Or is this something that is trying to put forward a political message to whoever will come in, who he will select to the Federal Reserve?
Can I say both? Because it feels like both. We might get something different, though. Aditya, Bhave of Bank of America was on the programme just moments ago. Let's just pick out the data points we get later this morning. 8:30 Eastern, PPI, jobless claims. Jobless claims at the moment, 226. We're looking for 225 this morning. And Aditya Bhave is basically saying this labour market is better than you think it is, one. And two, we're looking at the credit card data, the card data at Bank of America, and we're seeing a step up in spending, and we're looking for a re-acceleration in the U.S. economy.
Yeah, in some of the most discretionary parts of the economy, we're talking about things like airline spending, which has been one of the components of CPI that came in hotter than expected in Tuesday's report. A real question here also about those initial jobless claims that we're going to get in about 90 minutes' time. We've been talking about how they haven't really moved. They've remained around 220,000. Aditya's point, the overall labor base has expanded so much that that's an even lower number than it has been traditionally. Are we measuring the labor market correctly, either to the upside with some sort of reacceleration or to the downside, akin to what we saw in the labor market report 2 Fridays ago?
Its basic message is you can have a step down in payrolls growth without an increase in slack. That just because you're seeing this step down in payrolls growth, it doesn't mean the labour market's falling off a cliff. In fact, he's got very different views on that. What I find amazing about this moment is that we've actually got some real debate on Wall Street, away from the market. The economics debate at the moment can break either way, which I think begs the question, is the jury still out? Without a doubt. Can you draw firm conclusions by the time you get to Jackson Hole? Can you draw firm conclusions by the time you get to mid-September, even with an extra CPI, an extra payroll sprint?
And to build on your point, can you have your cake and eat it too? Can you have a Federal Reserve that cuts rates by as much as this administration says that they should be, while keeping inflation expectations under control and while continuing to allow the economy to expand at a decent pace? Is that a feasible goal at a time where this economy seems to be on a razor's edge, breaking one way or potentially another?
This market's just breaking one way, up and away. All-time highs again in yesterday's session. Futures this morning just a little bit softer. Coming up this hour, we'll catch up with Ed Yardeni of Yardeni Research as stocks look to build on record highs. Ed Mills of Raymond James on a new model for U.S. sales in China. And the former World Bank President David Malpass on the race to be the next Fed chair. We begin this hour as rate cut bets send bond yields lower and help send the stock market back-to-back all-time highs. To discuss, Ed Yardeni of Yardeni Research joins us now for more. Ed, welcome to the programme, sir. Can this market, as we've been discussing, have its cake and eat it too?
It's doing it right now for sure. We've had a very strong bull market really since October of 2022, and it hasn't stopped. We had a correction at the beginning of the year related to uncertainty about Trump's employment policies for the government with DOGE and uncertainty about tariffs. And so naturally, if you're an employer, you're going to hold off on hiring and not necessarily fire anybody. And so I think a lot of the soft patch, which is I think what it's been, is related to uncertainty. And I think the markets are starting to conclude that, you know what, uncertainty is going to be with us here for a while. Let's move on with our businesses. And I think the economy is in good shape.
The enthusiasm is starting to spread beyond the big tech story. 2 days of really decent days of gains for small caps. Now, Ed, whenever this market participants get a sniff of outperformance on a small caps, the excitement starts to build again. Is this another head fake or the real deal?
Well, we've had lots of head fakes in that regard, really, since 2018. Roughly around then, we did see that mid caps consistently underperformed the large caps, the S&P 500. I'm looking at the S&P 400 mid caps, the S&P 600 small caps. They just kept underperforming. Every now and then you'd get a head fake. And I won't be surprised if this is another head fake. I'm not telling anybody that it's not tradable. I think clearly it is tradable, as previous head fakes have been, but they don't last very long. And the reason is that earnings of the small cap, mid cap companies just continue to be in a coma. They've been flatlining since 2018. And I think they're doing that because the good ones keep getting bought out by the large caps. So you never really get a situation where you can buy a small cap and have it turn into a Microsoft.
If the Fed were to cut by 50 basis points next month, would you change your view? Would you see this as something other than a head fake?
Well, I think then I would just say we're in a melt-up. I mean, it feels like a melt-up already. We've seen this, the correction at the beginning of the year. We've seen multiples go from 22 forward PE for the S&P 500 at the beginning of the year down to 18. We didn't get down to 15. We didn't get down to 10. The market figured out and kind of agreed with me that the economy was resilient and we're not going to have a recession. And when it did that, suddenly, boom, we went right back up to 22. And so the market ain't cheap. And the reality is if the Fed cuts when there's still, as you said, a lot of ambiguity about whether it really needs a cut, it doesn't really need a 50 basis point cut, let a 25 basis point cut. The administration needs interest rates to come down because they'd like to see the interest costs of the debt come down. But the economy, I think, is going to surprise everybody in the next few months, especially the consumer, as you also indicated, and show some resilience in the consumer part. And capital spending, a lot of it is technology related. That's going to continue to go. So I think, as the drums beat for more rate cuts here, and we're probably now going to get one in September, and then there'll be expectations for another one after that before the end of the year. I think we're in a melt-up situation. So, right now I'm still kind of sticking with 6,600 on the S&P 500 by year end, because I think there's still a couple of indicators here that might suggest that maybe the Fed shouldn't be lowering rates. But absent that, we could go right back to 6,900, 7,000 by the end of the year in a melt-up situation. And the problem with melt-ups is they're followed by meltdowns.
Well, that's where I wanted to go, Ed. This is something that you talked about a couple of months ago, that you're worried if the Fed cuts rates too much, you could end up with a bubble, and that you could end up with a late 1990s type scenario that leads to the meltdown that you are referring to. How close are we to that if we do get the series of rate cuts that the market's currently pricing in?
Well, before we go there, let me also point out that at the end of last year, I also felt that there was no need for the Fed to lower interest rates. And I said that if the Fed did lower interest rates, bond yields would go up. Little did I know that the Fed would do 100 basis points all told at the end of last year. And guess what? The bond yield went up 100 basis points and frustrated all those people who want to see mortgage rates come down and corporate rates come down. So the Fed eased, but the bond vigilantes tightened. And we have that possibility again now. So just because the Fed eases, let's watch what the bond market does. It may not be very happy with the Fed moving to lower interest rates when the Fed's been telling us for a long time that they need to get their inflation rate down to 2%. And right now it's closer to 3% than 2%. But yeah, I mean, a 1990s style scenario is a possibility. I mean, right now AI looks like it's on a much firmer footings with earnings than we saw back in the tech wreck that occurred in the late 1990s, early 2000s. But in this market, you never know. I mean, DeepSeek came out of nowhere in January and created a pretty nasty correction.
Deep poo. And then we bounced back pretty quickly, didn't we, Ed? That's the stock market.
Yep.
I want to tease out what you just said about the bond market. Do you see then a similar backdrop this time around to what we saw take place back in September?
Unfortunately, I do. I think that the bond market is not going to like the Fed kind of caving into political pressure and easing. I mean, I think a lot of Fed officials are probably on the fence, but they're getting pushed over to the easing side by the political pressure. And that being the case, I think the bond vigilantes, that's what the bond vigilantes are supposed to do. They're supposed to maintain law and order in the credit markets and in the financial markets and the economy if the sheriff decides to go out to the saloon.
Not seeing much law and order right now, Ed. Appreciate your time. Ed Yardeni of Yardeni Research. Thank you, sir. So let's go back to last year, September last year. Federal Reserve comes out, drops 50, drops another 50 later on across 2 meetings. So across 3 meetings, down 100 basis points. What happened? Yields at the long end rose 100 basis points. Now, if Ed's right, we have a similar move by both the Federal Reserve and this market. That puts us a bit deeper into the 5% range on a 10-year maturity.
Which a number of people have raised as a possibility, given the fact that we still have inflation above 2%, and we could have more inflationary pressures that come down the pike. I just want to point out, so far this morning, we've heard the bond market described as too smart for its own good, and their goal of maintaining law and order. I love the sort of, incredibly powerful role that the bond market has gotten in the eyes.
Both too smart and lawless. Self-regulating might be the bridge between the two.
Yeah, the sheriff in town, but also, smarter than everybody else. It's the parent that all of us need, but maybe doesn't want.
Apparently. 420 is the parenting this morning. Yields are down by 2 basis points. Is that less strict? Maybe. I'm not going to...
I think that this is a very reasonable parent right now.
Let's get you an update on stories elsewhere. What are we doing? Let's get you Bloomberg Brief with Yahara. Hey, Yahara.
Hi, John. President Donald Trump warned Russia that he would impose very severe consequences if Vladimir Putin doesn't agree to a ceasefire with Ukraine. Trump is set to meet with Putin tomorrow in Anchorage, Alaska. He said he hoped to use the meeting to set up a quick second meeting with Putin and President Vladimir Zelensky. Meanwhile, last month was the busiest month ever in the Port of Los Angeles' 117-year history. The port moved more than 1 million containers in July, which was an 8.5% increase from a year ago. The rise came as uncertainty over President Trump's tariffs drove shippers to front-load their cargoes. And President Trump signed an executive order to ease regulations for the commercial space industry. The order could directly benefit Trump's one-time ally, Elon Musk's SpaceX, as it ramps up test flights of its gargantuan Starship rocket. First buddy again? Time will tell. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in about 30 minutes from now. Up next on the program, taking a slice of corporate America.
This is a very unique solution, allows NVIDIA to expand into China. It can make NVIDIA chips the bellwether for Chinese technology, and then the U.S. taxpayer gets a share of that.
Unique. Just how unique is it? Ed Mills of Raymond James joins us next. In 1 hour and about 15 minutes, we'll get some economic data. So let's call it 8:30 Eastern time. You'll get another read on inflation with PPI data and another read on the labour market with jobless claims. And jobless claims data is set to look pretty good based on the estimates in our survey. We're still looking for something close to 225, which is better than pretty good, actually. It's pretty phenomenal, given what's happening elsewhere. So that's the story for the data later on this morning. Here's the story for the market. Equity futures at the moment on the S&P 500. Pulling back just a touch. We're down by not even 1/10%, following yesterday's all-time highs. Under surveillance this morning, taking a slice of corporate America.
This is a very unique solution, allows NVIDIA to expand into China. It can make NVIDIA chips the bellwether for Chinese technology, and then the U.S. taxpayer gets a share of that. We could see it in other industries over time. I think, right now, this is unique, but now that we have the model and the beta test, why not expand it?
Here's the latest this morning. The U.S. Treasury Secretary Scott Bessent telling us the deal allowing NVIDIA and AMD to sell chips in China for a share of their revenue could be replicated in other industries. Joining us now, a man who follows these stocks and this industry is Bloomberg's Tom McKenzie. Now, Tom, you and I were talking about this earlier this week, just how unique is it? And talking to the Treasury Secretary yesterday, maybe not that unique.
What a remarkable line that you and Annmarie managed to get out of the Treasury Secretary, of course, saying that this could be applied to other sectors and other industries. So you have to wonder, if you're a Boeing, if you're a Qualcomm, if you're a Ford selling into that second largest economy, of course, do you have to start to think about or put in place some mitigation, start to factor this in as a potential price to pay to play if you want to get access to that Chinese market? Or do we need to think about it more narrowly in terms of national security? And even if you do that, what about the jurisdiction when it comes to the US? Do you need to start to think, if you're ASML in the Netherlands, in Europe, or if you're Tokyo Electron over in Japan, with that feed into the semiconductor industry of China, do you need to start to think that maybe the US is going to start putting pressure on you in terms of not just those export licenses, but maybe even if you do get some easing there, what does it mean in terms of the revenue hit? Potentially, where does that revenue go? Maybe that's taking it too far. But I think in terms of the national security concerns that you addressed with the Treasury Secretary, they're clearly still there. And if you're in other spaces with significant exposure to that Chinese market, even where growth is looking a little challenged, it's got to be a question for you going forward.
Tom, I'm really glad that you went there. How can we understand national security and how much it's offset by some sort of fee that a company pays the U.S. government?
How does it get offset? I mean, the key thing to think about is that both sides, China and the US, and this came through in the first Trump administration, and you felt that on the ground in Beijing, both sides putting extra focus on the question of national security. I remember then the Secretary of State, Mike Pompeo, making an overture around potential regime change, making a nod to that in the first Trump administration. And you saw a significant change in terms of the posture of the security apparatus in China as a response to that. You go all the way back to then, and that continues to weave through the narrative right now. They are acutely aware, of course, in the US and in China, that this comes down to national security, whether it's semiconductors or the broader picture around the economy and the trade relationship between these two nations. And it's a tension, clearly, that lies at the heart as well of how things accelerate on the innovation and AI story. China's got its competitors in the race when it comes to AI and these models. They're key competitors that they lent into. They've had the flesh pressing with Xi Jinping, the likes of DeepSeek and Alibaba and others. They're the golden children, but equally, China wants them essentially to run on the track, the 100-meter track, with their arm tied behind their back, because they want them to be using Huawei chips and not NVIDIA's.
Strong point, Tom. Appreciate it, sir. Tom McKenzie there, the host of Bloomberg Technology out of Europe, joining us this morning out of London. Ed Mills of Raymond James joins us now for more to extend this conversation. Ed, welcome to the programme. We spent so much time talking about taxes on inbound trade. Do we now need to start thinking about taxes on outbound trade?
I think you do. John, I think this is pretty remarkable because what we are talking about here are things that were restricted for national security reasons. Now, if it's restricted for national security reasons, it should be restricted regardless of how much you pay. So just because you're now willing to pay 15% of your profits should not oversee those national security concerns. I think the good thing so far is that what we're talking about are chips that were otherwise allowed before President Trump started to ramp up things on China. Those were things that I think a lot of national security officials thought were okay to go into China. If it were to expand and go to some of the chips that are at the leading edge with a profit sharing there, that's where you get a lot of concerns from Capitol Hill and other national security officials. If this is a model going into the future, this will be a huge concern for investors. I can tell you at Raymond James, I've gotten a couple questions about this week, but it hasn't been as overwhelmingly as a concern as the other tariff stories, especially the 232 on semiconductors. But if this builds, this will be big.
I imagine after those comments, you might get more questions, Ed, over the next several days. How are you thinking about things? Are there other industries that require export licenses that might be vulnerable here that perhaps we should be thinking about more?
Yeah, I think it is mostly within tech. And I think what has been the story since the first Trump administration is that we are looking at our technology as a national security asset. And so if we are allowing others to get access to that national security asset, we need to put restrictions around it. Or apparently we need to make sure that we get part of the profits around that. Going forward, I do think the semi-cap equipment is the most likely next step because where we've seen the biggest restrictions are in semi-cap equipment. And there's a lot of leverage in negotiations that we've been trying to put on the Dutch and Japanese governments as we are trying to get those standards that the United States has put on harmonized globally.
There's a very simplistic way of looking at this, Ed, which is that money can't compensate for national security concern if it truly is a national security concern. There is a more nuanced take on it that we were talking about earlier, which is that this national security risk is two ways. There's the risk of China getting U.S. chips and using them to exceed the capabilities of the United States when it comes to technology. There's also China becoming dominant and creating their own Belt and Road type of structure, using their own technology in the world and wanting to maintain a foothold. Do you get a sense that that aspect of national security is gaining clout in the administration and is part of why there has been this shift in this profit-sharing agreement?
Yeah, I think, Lisa, the two things that were probably the biggest arguments by NVIDIA and AMD is that if we do not allow these chips to be sold, these companies will be left out altogether. And that Huawei could take over. And maybe in the near term, the United States can keep this global dominance and kind of work with others to maintain that lead. But if we don't, if we're not part of the conversation, if we're not part of what is being used, will it be left behind? And are we going to see a complete divergence where there's going to be a China set of technology and a rest of the world set of technology? And if the China technology ultimately gets better, 5, 10, whatever number of years from now, if that supersedes the United States, that's a national security concern for the United States. So from that perspective, you can say, all right, let's make sure our technology is at least part of the conversation to maintain that dominance, because it's a bigger national security concerns if we don't have that in the long term, Lisa.
How much is this going to be a template for some of the U.S. trading partners that might be looking at some of their key resources and wondering how they can monetize that with exports?
I would be surprised if others really get involved here. I think Trump is unique in his willingness to be transactional, his pay-to-play aspect to this. I would be looking to see if there's other parts of the trade agenda. If you remember, all of the trade deals so far are MOUs. We don't have all of the details fleshed out. One of the key components of almost every one of those MOUs are huge purchases from other countries. Do you have the Trump administration going to those countries and saying, all right, we will let you buy some of these things only if we get a cut of the profit? So as we look at some of the agriculture, the oil and gas, the aeronautics that are being sold globally in these trade deals, when we get those final details, is that going to be something that there's going to be a percentage that goes to the United States government, in addition to the taxes and to the economic benefit we get to pay down the national debt? You've seen a lot of this kind of go on with the conversations about a sovereign wealth fund and a desire to bring down the debt and the deficit. If they can do that, then that gets pretty interesting from a debt and deficit perspective, but very concerning from a kind of U.S. government injecting themselves into corporate America conversation, Lisa.
Becoming increasingly interventionist, that's for sure. Ed, thank you, sir. Ed Mills there of Raymond James. I loved your question. As you were asking it, I was already looking at ASML over in Europe and thinking about the same thing.
I mean, how much do you just say, okay, well, ASML can't ship over some of their chip production equipment to the United States without giving the Netherlands, 20%. I mean, at what point does this become a self-fulfilling prophecy in terms of the way to do business in the chip wars of 2025?
Bottom line, there's a lot of governments that need to raise some money.
100%.
And they're coming up with new ways to do it. Equity futures on the S&P 500 just about unchanged this morning. Conversation continues. Up next, we'll catch up with the former World Bank President David Malpass on President Trump's search for a new Fed chair. Plus, Danny Berger with your morning movers as tariffs weigh on Tapestry's outlook. That name is down by more than 7%. Live from New York City this morning. Good morning. Two days of gains on the S&P 500, just about unchanged so far this morning. We're going nowhere on the S&P 500. On the Nasdaq 100, unchanged also, not unchanged in the bond market. 3 days of lower yields at the front end of the curve. The 2-year this morning at 366. 2 Fridays ago, following payrolls, 368 at the close. So we've held on to these levels post-payrolls, and we're looking for those big rate cuts.
With job owning from the administration, but also a couple of different Fed officials signaling a willingness to potentially cut rates, at least by 25 basis points, not 50 basis points, looking at what the market's pricing in. Fed funds futures looking at a full 25 basis point rate cut baked in for next month, and another one by year end, but starting to push in maybe a little bit more than that.
A lot of this is going to hang on what happens in early September when we get that next payrolls print, and a week later when we get another read on CPI. Later this morning, 60 minutes from now, another read on inflation with PPI and jobless claims for a look at the labour market. With 2 hours until the opening bell, let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. Tapestry getting hit pretty hard in the pre-market. They were just out with earnings. Those shares down 8.33%. The aspirational goods maker, Kate Spade, among them. They gave an outlook for the year that looks pretty bad compared to last year. Only 4% growth. Last year was 7% growth. And within those estimates, it would appear that their EPS is taking a 60-cent hit from tariffs and higher costs specifically. So it's a new incorporation that the street has to put into their share price, and you see that underway. We also heard from Deere, those earnings also out. Also a negative reaction there. For their outlook, it was a cut to their outlook. On one side of the thing, it's supply. There was a record American corn harvest. And then there's the demand side, with that being uncertain given the trade wars undergoing in the United States. Because of that, farmers buying less equipment, shares down 5.5%. Just want to end on the positive thing taking place in the market, and that's the continued hype around crypto and an IPO yesterday from Bullish. This thing rallied 84% yesterday. The crypto exchange, when it debuted, shares move higher yet again this morning, up 15.7%, John.
Danny, thank you. What a name. And with a name like that, does that just become the proxy for the broader market? Bullish?
Yeah, it's either bullish or it's not. And ultimately, if it falls by more than 10%, you know where you're going to be.
Ridiculous performance. OK, let's move on. On our radar this morning, President Trump issuing a warning to the Russian President Vladimir Putin, saying he would impose very severe consequences if a ceasefire agreement isn't reached. The leader set to meet for high-stakes talks tomorrow in Alaska.
A lot at stake here from a humanity perspective, given how many lives have been lost in this conflict and how much this really has strained the economies of the entire region. That said, and to take a more sort of markets perspective, and I apologize because it seems somewhat harsh, but have people priced in too much in terms of expecting a ceasefire coming out of this when it comes to the oil market? We've seen oil prices come in, yes, because of oversupply, but how much does this include oversupply coming from potentially Russia? Should there be some sort of ceasefire or normalization of ties? And how much could that bounce back if you don't get some sort of deliverable from this meeting?
It's a good question to ask. This is the appropriate forum to ask it, I think, is what a lot of people watching this program are thinking about. What I'm thinking about when the president engages in these talks over the weekend, does he walk into the room with a carrot or a stick, or does he try and achieve both?
Yeah, and is it enough of a stick to say your economy is falling off a cliff? Norman Roule saying not so much, and that's really the issue. What is the stick that he has if he doesn't have the Europeans on board to really engage with secondary sanctions? And so ultimately, how high are hopes in markets versus in diplomacy circles?
And what's the carrot if he doesn't have permission from the Ukrainians to have a conversation about the integrity of Ukrainian territory, which, based on what we've heard over the last 24 hours, he certainly does not?
Yeah, how much leverage does he have? This is another way of asking a really important question, which is he walking in, I'm talking about President Trump, with cards that can really achieve what he's looking to set out to do?
The message you're set to get, based on what we heard from Norman Roule, so not my opinion, basically what he was saying, get a guy that comes into a room who knows a lot about business, who turns around to the Russian president, points to his economy and says it's doing dreadful. We can make this perform a whole lot better. Let's do some trade deals. Let's do this, let's do that. The problem with that is that's not really the guiding light of President Putin right now. Otherwise, he wouldn't have engaged in this war to begin with.
Economic rationale has never been the lodestone of Russian imperialism, so it's hard to see how it would be right now.
Those talks are going to play out over the weekend. As I mentioned in the previous hour, Annmarie on the road today. She'll be over in Alaska following those talks for you, bringing you all the headlines Friday and through the weekend. Wanted to squeeze in this story. Chinese startup DeepSeek, remember them? Delaying the release of its latest AI model. Sources telling the Financial Times that DeepSeek struggled to train systems using Huawei chips. So at the start of this week, we had this deal with NVIDIA. Then we had this report here at Bloomberg that the Chinese were telling some companies that you should not be using those chips, use Huawei. And this is what we're hearing from the FT. I think this is really interesting stuff.
And it goes to the point that you made earlier. Deep who? We talked about how DeepSeek was transformative earlier this year, that China could do so much with so little and really create these sophisticated OpenAI types of chatbots. Question here. Could they actually have achieved that without using some of the more advanced U.S. technology, number one? Number two, how much does DeepSeek really rely on that ongoing U.S. technology, and how much can this really inform President Trump's decision to levy some of these chips and the exports over into China? It does raise a question, though, also about just how far ahead China is when it comes to their tech development and whether they are as close to the United States as so many people have said.
I mean, to clarify, not to throw too much snark at a company that has done something pretty phenomenal. Deephu, based on the rebound we've seen in tech stocks in America, has just been absolutely phenomenal.
They had been driving everything earlier. Remember the huge swoon in U.S. tech because people said, oh, it's over. People are going to stop investing. You could do the same thing with a little chip here as you can with a whole room of chips. And then maybe not so fast. And now we're back to the AI trading.
There was a phrase that NVIDIA CEO Jensen Huang used, export compliant. Still rattles around my brain sometimes. How export compliant were the successes, the achievements of that company earlier this year?
And can they continue with these types of successes with the H20 chip, given the fact that it is, what some people have said, years behind the latest and greatest from NVIDIA that's sold into U.S. and its trading partners?
That's the latest on tech. I wanted to turn to this, the latest on trade. The Port of Los Angeles seeing the highest container volume in its 117-year history in July. The port's executive director, good friend of this program over the years, Gene Soroka, attributing the spike to traders front-loading cargo before President Trump's import duties take effect. So what is Gene Soroka telling us this morning? Gene Soroka is telling us that we've got a lot of pre-tariff inventory still working its way through the economy last month and potentially this month and the months to come.
That is exactly the point here. Essentially, how much can we take a look at how much inflation's been passed along from the goods that have been imported so far since some of the tariffs have gone on, and said that's what will continue? Because guess what? A lot of that inventory did not receive the same kind of tariffs that some of the future inventory will, because it was brought forward. People are trying to take advantage of any windows that they possibly can. It just shows how messy it is to categorize the inflationary impulse from some of the policies that have taken place.
It's really difficult for any of us to draw conclusions, including officials over at the Federal Reserve. The president, by the way, saying he'll name the next Fed chair earlier than perhaps as expected. The Trump administration announcing he's down to 3 or 4 names after previously floating as many as 11 candidates. Joining us now to discuss is the former World Bank president, David Malpass. David, my good friend, welcome back to the program, sir. Let's talk about the leader of the Federal Reserve and the next Fed chair. What are the characteristics that we're looking for here, David, in the next Fed chair?
Hi, John and Lisa. I think what is needed is a lot of change at the Fed. So the characteristics are someone that will bring change and really confront the PhD economists that have been running the Fed. You heard some of that in your previous guest talking about the bond market vigilantes and the parent we all need. I think that getting the Fed out of the way of the market and creating the rationale for a much lower interest rate curve along the curve, I think that's what's critical. I was very happy to see Secretary Bessent yesterday talk about 2 things. One is the 50 basis point cut possibilities, and also the need for foundational change at the Fed. That, to me, means more loans for small businesses. So that's going to be one of the opportunities for the U.S. as we change the supply chain.
You said in some of your previous comments that the Fed is using old models that are wrong on economics. Which models in particular do you think are incorrect?
There's a long list. How long do you have? The Phillips curve doesn't work. The idea of ample reserves doesn't work. The idea of inflation targeting using backward-looking data doesn't work. There's a big opportunity there. If you used forward-looking price-based data, you could get lower interest rates and the market would welcome it. That's what we saw yesterday, I think, when the Secretary said foundational change. There are better ways to do this than what the Fed has been doing. They lean against growth, Lisa, and that's been part of the problem, that when the economy gets going, they say, oh, that's overheating, when actually that's what we want. That's the goal of economic policy, to have non-inflationary growth.
David, a lot of people would say that when they don't tamp down on inflation, it's been asset price inflation that's really run away, and that has led to a number of pretty significant crashes. What are you pointing to in particular in terms of practical consequences that point to some of those policies? I mean, what do you think the growth rate should be in the United States right now if the Fed were using the models that you would like to use?
I think the growth rate can be comfortably 3% real GDP growth, maybe 4%. The Fed has a potential GDP speed limit. They just published on June 18th the idea that it should be 1.85% per year. So that just doesn't make sense given the possibilities of regulatory change, the recent tax stabilization. So they took the tax cut, the tax increase that Biden was planning and Biden-Harris were planning, and took it off the table. So that's it. That allows businesses to begin investing for the future. Lisa, the Fed has perpetuated this idea ever since Paul Volcker that high rates are the way to bring down inflation. The reality is more production is the way to bring down inflation. And Trump's doing that with all the changes going on in the economy.
David, I'm happy for people to make the accusation that perhaps this Fed chair has been reckless with monetary policy, but I'm far more sympathetic to the idea that he's been recklessly dovish. This is an individual that led a Fed that let inflation absolutely rip. This is an individual that saw markets doing okay, equity still close to all-time highs, and cut interest rates 100 basis points. David, can we really make the argument that they've been recklessly hawkish?
Yes, they're hawkish right now. And look at the difference in the environment they were cutting into. It was politicized in 2024. There were heavy regulations stopping business. There was no investment going on. And yet they were cutting, thinking that inflation was transitory. What we have now is a big change going on in the economy. And I think the opportunity for capital to flow into the U.S. As you make the economy stronger, you're going to get support for the dollar. And again, we have to look at how the markets reacted yesterday favorably, whereas when the Fed was cutting during 2024, markets reacted unfavorably. So there's a huge difference.
Look at the difference between the market right now, though, and what the Federal Reserve is ultimately projecting. David, I don't think there's too much daylight. This is a market and a Federal Reserve that seems to be on course to cut interest rates somewhere between 100 and 150 basis points. What we heard from the Secretary of the Treasury yesterday was they need to cut from 150 to 175. David, I understand this should be a healthy debate, but is there really that much controversy between what the administration would like to see and what's ultimately being projected by both markets and the Federal Reserve alike over the next 18 months?
I think that's useful. The markets are looking at what's going on in the economy and realizing that there can be a lower interest rate environment for the United States across the whole yield curve. I think that's important, and that adds to growth. Look, the goal here is a virtuous circle where capital flows in, where growth goes up, and production goes up, and that brings down prices. So then you can keep doing interest rate cuts. You get a virtuous circle. I think that's possible. It's going to be really important for the Fed and PhD economists to get to realize that their models haven't been working over the years. We've had these wide swings in inflation and deflation and interest rates because the Fed's looking backwards. And so we need new models, sweeping change in the models. That's been what I've pointed out, and it will benefit small businesses. That's the key.
David, looking forward and using your models, what do you think the neutral rate is?
I think the neutral rate is lower than where we are now. You know, the Fed keeps saying that the interest rates are appropriate right now at 4.4%. How do they know that? They're the ones setting that rate and paying banks, a lot of them international banks. 40% of the money payout by the Fed is going to international banks, and they've paid $1.3 trillion since they started paying interest to banks. So they're affecting affecting the markets, and they don't know what the neutral rate or what the bearable rate is.
Well, to be fair, David,
they
no one
tend to
knows,
set
as
the
you know,
rate
but they're
as,
taking a stab at it. They think the longer-term rate's something close to 3. So what do you think it is? Close to 3 is like 150 south of where we are at the moment. What do you think it is? How much lower than that could it be?
I think the strength of the U.S. economy justifies lower rates across the curve, substantially lower, and the market is looking at that and already beginning to price that in. And it's part of the favorable environment being created.
I think we've lost the connection with David Malpass. I was quite enjoying that, and I know David was too. A spirited conversation with the former World Bank president, David Malpass.
Yeah, talking about how different models are required to really adequately look forward at a time when he believes that the neutral rate should be a lot lower. He said that there seems to be some sort of speed limit to the GDP that the Fed has in its mind, and it's sort of this debate of how you modulate these two mandates, both of unemployment rate as well as inflation, and it will continue to be a robust academic
Cue
debate.
the controversy. Who killed the line? Who cut
Yeah,
the
exactly.
interview?
Totally. Some
My
people are going to
apologies
say
for
that.
the technical problems there. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. The U.S. is open to discussing the use of NVIDIA chips with China. Speaking to us yesterday, U.S. Treasury Secretary Scott Bessent said they're open to that since a lot of Chinese tech is already piggybacking on the U.S. And as you guys have been talking about this morning, Bessent also noting that the U.S.'s deal with NVIDIA and AMD to get a 15% cut from its China chip sales can be used to pay down the U.S. debt. Meanwhile, a U.S. appeals court says the Trump administration can block billions of dollars in foreign aid already approved by Congress for distribution. Separately, a Maryland federal judge has rejected the Trump administration's attempt to throw out a lawsuit that accuses Elon Musk of unlawfully directing the closure of USAID. And Amazon plans to offer same-day grocery delivery in 2,300 cities by the end of the year, more than doubling the current number. It says customers will be able to order perishable items alongside frozen foods and household goods. The same-day grocery delivery service will be free in most cities for Amazon Prime subscribers on orders over $25. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour, in about 30 minutes from now. Up next on the programme, looking for the Fed to go big.
I do think we could go into a series of rate cuts here, starting with a 50 basis point rate cut in September. The rates are too constrictive. We should probably be 150, 175 basis points lower.
Coming up, we'll catch up with Sonal Desai of Franklin Templeton Fixed Income. That's up next. This is Bloomberg. Live from New York City, welcome to the program. Under surveillance this morning, looking for the Fed to go big.
We could have had rate cuts in June and July. So that tells me that there's a very good chance of a 50 basis point rate cut. I do think we could go into a series of rate cuts here, starting with a 50 basis point rate cut in September. The rates are too constrictive. If you look at any model that we should probably be 150, 175 basis points lower.
Here's the latest this morning. The Treasury Secretary, Scott Bessent, calling for a 50 basis point rate cut as traders fully price in a quarter-point cut in September. Sonal Desai of Franklin Templeton writing the scope for rate cuts is extremely limited, barring a sharp slowdown, because we're very close to my estimate of the natural policy rate. Sonal joins us now for more. Sonal, welcome to the programme. Some real daylight then between you and the Treasury Secretary and some of the market pricing. Just build on some of that and explain as to why.
So, okay, I think the market at the short end is pricing wishfully. The market always does, and it's done it several times over the past several years. I would say this, based on perhaps also listening to some of your previous guests, the Fed has done itself no favors. It really hasn't by what it did last year. Across any metric, if you look at the different metrics of unemployment, NFPs, CPI, core CPI, the Fed actually would have had a 50 basis point rate cut would arguably be more justifiable this year than it was last year. Didn't agree with it last year, and I still don't think they should be doing 50. They have said in their SEPs that they will do 50 more. maybe you could get away with that. I'd say that my natural rate for Fed funds is around 4, and that comes from a very simple place. Even if the Fed is correct and it's, the potential GDP is at around 1.85, I think 1.852 is probably all right, because that's around where productivity growth is. You take that and you take the Fed's target of 2% inflation, you do not get to 3%. You don't get to 250. You get to around 4. That's where the natural rate is, and that's what I mean. Absent us falling into a significant recession, the Fed doesn't really need to cut that much more. That's what I'd say. And the market will price what the market hopes for. And if we're talking about kids at a party, well, the Fed kind of gave us the punch bowl when it's, that's what, they haven't given it to us, but that's what the market is hoping for right now.
So Ed Yardeni, who we were speaking to earlier, was talking about how he could see a repeat of what happened last year when they cut 100 basis points. If they cut 50 basis points this year, he could see some sort of steepening in the yield curve, long end yields rising substantially. Do you agree with that?
So, the only part about that where I'd say, I think that long end yields, look, I've been saying for a long time that I could easily see long end yields at 475.5 by the end of the year. I haven't changed that view based on the volatility we've been seeing. We go down to 420, we go back to 440. I think that long end yields could comfortably go to 475.5, given that I think that the neutral rate for the Fed is at around 4. Now, could we see a steepening just on the back of this? Yes, with one caveat, and that is, I would agree with what Mr. Besant was saying yesterday in terms of the additional revenues coming into the fiscal picture. We haven't really, I think, in the market paid sufficient attention maybe to the fact that none of us last year were anticipating any narrowing of the fiscal deficit. And it could even happen. And that would be quite stunning. And that would be one thing which would perhaps prevent us from going much beyond that 475.5 level.
This is something the Treasury Secretary was talking about. Sonal's absolutely right. When we asked him how much money's being raised, he was talking about, initially I thought something like 300 billion in a year. Maybe we've got to upward revise that number to something a whole lot bigger.
Which is a reason why yesterday some people were suggesting that was why you didn't see a selling off in longer term yields. Because of your conversation and what Scott Bessent said, this would offset some of the deficit concerns that people had heading into this year.
Deficit concerns internationally, though, are not going away. And that's the issue they've got, which is why I keep coming back to this 30-year piece. It's a question we've got to ask authorities around the world right now. What's your incentive to issue a 30-year when, based on some of the price action, the auctions that we've seen worldwide, not many people seem to want to touch it?
Right, because this is going to be an international issue. That said, it's very hard for the United States to take the moral high ground on that, given the fact that they haven't exactly been fiscally responsible, and it's not exactly as if Germany is just completely overloaded in debt. So there is a very difficult discussion to be had here when the United States starts sending this message.
Hey, Sonal, appreciate your time as always. Sonal Desai there, Franklin Templeton Fixed Income on the bond market worldwide and the Federal Reserve. Coming up on the programme, we'll catch up with Tracie McMillion of Wells Fargo. We'll speak to Pierre Ferragu of New Street Research on Apple's latest AI efforts. Nela Richardson of ADP looking for jobless claims in about 34 minutes' time. Plus, Scott Chronert of Citi with a new price target on the S&P 500. I'll give you a hint. It's higher. From New York City, this is Bloomberg.
Inflation data, labor market data, you really need to dig under the surface to get a true sense of what the impact is.
Inflation is alive and well.
The market is pricing that inflation expectations have almost become unanchored already.
You'll still see, we think, some pass-through of higher tariffs onto prices.
Inflation might run hot well through next year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The opening bell about 90 minutes away. The economic data 30 minutes away. Let's start with your scores. Let's start with the markets. Equity futures just about unchanged on the S&P 500. Likewise on the Nasdaq 100. In the bond market, not unchanged at all. Multi-month lows on two-year government bond yields. Your two-year this morning, 3.66. Going into this a little bit later this morning. Data in America. PPI and jobless claims 8:30 Eastern Time.
So are bond yields falling for the right reason? For the PPI report that could echo what we heard in CPI on Tuesday, which demonstrates that we aren't seeing the same kind of pass-through inflationary effects of tariffs that a lot of people had been worried about. Is that the reason why you are seeing bond yields fall and expectations for Fed rate cuts increase? Or is it because of the bad news, which is the labor market deterioration that some people saw in the non-farm payrolls report that could be echoed in jobless claims that haven't really done much? If anything, they're actually incredibly low.
Sitting in this seat, we often hear a lot of complaints about complacency. It's often justified. I'm not pushing back against that. Groupthink, often justified, not pushing back against that. But on this occasion on Wall Street, I'm seeing a lot of diversity of thought. We heard from Aditya, Bhave, Bank of America, in the last hour, who turned around to us and said he thinks this labour market's okay. Minutes ago, going into claims, Andrew Hoddenhorst of Citi, labour market's not solid. You ask one economist right now on Wall Street how the labour market's doing, they'll tell you one thing. Ask another, they'll tell you something completely different, looking at the very same economic data.
Because there are cyclical and there are structural changes, as you were pointing out earlier. You have demographic changes with aging, you have demographic changes with immigration, and you've got demographic changes when it comes to which roles are going to be most important with artificial intelligence, machine learning, changes in some of the structure of the labor economy. This is the reason why Jackson Hole is going to be so important. Does the Fed change the way they measure strength or weakness in the labor market at a time where that is part of their dual mandate? And it is so hard to understand exactly how much slack, as you said, there actually is, or whether we could still see wages growing at a healthy pace given the few workers to fill those roles.
Yeah, we've been framing this as follows. Are we seeing a cyclical turn in the economy or a structural shift? Are we seeing demand destruction or just a supply-side phenomenon? Are we seeing a step down in payrolls growth without the increase in labour market slack? And ultimately, the more constructive people on Wall Street right now think that's the case. That you can see that step down in payrolls growth, but because of what's happening on the supply side, you're not seeing an increase in slack and the labour market is still okay. The Fed chairman, by the way, in the last meeting, we were sat here around the table listening to the news conference. He was pretty clear. He was anchoring his view on the labour market around the unemployment rate. Now, we can have some debate about that. Maybe you think it's misleading. I don't know. But that was his view in the news conference. I'd like to know if it's changed.
And I would like to know whether people actually do think, as you said, this is a market that can have its cake and eat it too. Because right now you're seeing equities reach all-time high after all-time high on the heels of these rate cut expectations, even if this is a Fed chair, albeit in his twilight as Fed chair, who is watching the unemployment rate and will only cut rates to that degree if there is real substantive deterioration, which would suggest some sort of weakness of the companies that people are bidding up in value.
You'll hear from the chairman a few times over the next month or so in Jackson Hole. Lisa will be there. Then again, of course, in that news conference at the Fed meeting a month or so away. Lisa talked about the market, bond yields breaking down to new lows. This bond market rallying alongside this move in the equity market. New highs again this morning. Equity futures just about turning positive. Coming up this hour, we'll catch up with Tracie McMillion of Wells Fargo as stocks look for a third day of gains. Pierre Ferragu of New Street Research on Apple's latest AI push. And Scott Chronert of Citi raising his year-end price target on the S&P 500. We begin this hour with stocks steady as investors await the latest read on inflation. Tracie McMillion of Wells Fargo writing the S&P 500 is powering ahead, but expect tariff surprises and economic slowdown to stall the equity rally in the intermediate term. Tracie joins us now for more. Tracie, welcome to the programme. Let's just talk about why you're pushing back a little bit against these record highs we've been minting over the last few months or so.
Yes, we are pushing back a little bit. We are trimming and we're rebalancing the portfolios. We've had such a strong earnings season. There's a lot of optimism priced into markets, and we're going into a seasonally weak period. So we think it's time to trim some of the gains in our large cap positions, take our small cap position to an underweight, and take some of that overweight position that we've held in the equities asset group all year, move that into intermediate term fixed income, and look for some chop as we move through the remainder of this year.
Tracie, just stick on the equity component of that call. Moving the small caps to underweight after a couple of days where the small caps have performed quite nicely. Now, Tracie, as we talked about this with Yardeni earlier, trying to work out whether that breakout in small caps, small breakout over the last few days, is just another head fake. Why move the small caps portion of the equity exposure to underweight?
Sure, yeah. We do think that's probably another head fake, and that's been very consistent with small cap performance over really the past few years. We've seen hopes that interest rates will move lower and that will support small caps. We think that that's what we're seeing again this time. However, our expectations for interest rates differ from what the market is expecting right now. We do not see as many rate cuts as the market does. So we don't see that as a support for small caps. We see small caps as a part of the market where earnings potential is just not as strong as the large caps and the mid caps.
Tracie, you point to some of the tariff ramifications as one justification for why you're not as bullish for the remainder of this year when it comes to equity performance. And it seems like that's justified when you take a look at some of the earnings calls in terms of the absorption of these extra levies in profit margins. You see this across the board from Caterpillar, from Hershey, from Ford, with a $2 billion hit talking about that. General Motors, why do you think the market hasn't responded more to that already? Because we already have seen some concrete numbers of just how big these bills will be.
Sure. So we have already started to see some of those numbers. And, if you think about where we started the year at about 2.4% for tariffs, we're going to end the year probably at 18 plus is the projections that I've seen for that. So that is a big differential. As you said, companies are absorbing those into margins, which have been very strong at the moment. We think that that's going to also be a pass-through to the consumer when both companies and consumers benefit early next year from tax cuts, from potential additional stimulus, and from deregulation. So we think that's why markets keep powering ahead, because they see the potential for those things to mitigate some of the tariff negativity in the coming year. We agree with that. We just think over the coming months in 2025, it could be more volatile, could be more choppy as we see additional tariff surprises come to the fore.
By that same logic, Tracie, there is sort of this stagflationary element to what you're talking about, the idea that prices go up, but that growth slows down. And ultimately, that should be, over the longer term, pretty good for long-term bonds. Not necessarily if it's actually stagflation like the 1970s, but if that leads to a period of lower growth and you have the coffers of the Treasury Department getting filled by some of the tariff revenue. How much are you seeing this as a bull case for longer-term treasuries?
So we really aren't seeing this as a bull case for longer-term treasuries. Instead, we like the intermediate part of the curve because we think that rates are actually going to stay around the level where they are. Our midpoint for 2025 is 4.25 on the 10-year. We move that up to 4.5 next year. So a bit of a rise in longer-term rates is what we're anticipating as inflation stays firm and as U.S. debt continues to increase. Yes, there's some offset from tariffs, but we're just not convinced that that's going to be enough to really draw down the debt and the deficit.
Tracie, appreciate your views. Thanks for joining us. Tracie McMillion there of Wells Fargo on both equities and bonds. So this is the view. Equities bring down your exposure, small caps to underweight, position in the bond market in the intermediate part of the yield curve, which I think is actually pretty interesting because typically we might say, well, if you think there's going to be a slowdown, some risk aversion, go out further along the curve, take a piece of the 10-year. It's not what you're hearing at the moment, is it, from investors?
There isn't a belief that the tariff revenue can continue at a pace enough to offset the deficit in a way to really drive them into longer-term bond yields. And then there's the additional point, which we didn't talk about just there, which is the international backdrop and just how much yields globally are rising on that 10-year and 30-year denominations.
Kevin Gordon writes in. Did you get that email?
Yes, I did.
Charles Schwab, over the past 4 years, small caps, small performance, small games. Russell 2000 up by about 5.7% over the last 4 years. The S&P up by more than 44. And every time we get these moves over a period of like 2 days, the excitement comes back all over again for small caps.
They're cheap. They're buy. It looks really good on a chart. That said, when you hear some of the profit reports, you hear Amazon having free grocery delivery in the same day. You see some of the technological investments that the behemoths are making. You wonder how much of a competitive edge some of these smaller companies actually have, let alone ability to compete in profitability.
The Russell is down by 0.3% this morning. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's your high Yahara. Hey, Yahara.
Hi, John. We are seeing the Japanese yen strengthen against the dollar this morning, and JGB yields are ticking higher as traders woke up to Treasury Secretary Scott Bessent's comments on our program yesterday that the BOJ is behind the curve and said Japan needs to get their inflation problem under control. Meanwhile, Oracle is cutting jobs in its closely watched cloud unit, taking steps to control costs amid heavy AI infrastructure spending. Sources telling us here at Bloomberg, impacted workers were informed this week that their roles were eliminated. More than 150 jobs were cut in the Seattle area, which comes as Oracle prepares to move its headquarters to Nashville. And rents on Manhattan apartments hit a record in July for the fifth time in the past 6 months. Prices surged more than 9% from a year ago, marking the second biggest annual jump since 2008. In Brooklyn, the median rent on new leases climbed to $3,850, the second highest level on record for the borough. That's Bloomberg Brief. John?
It's basically 4K, which is absolutely bonkers. Yahara, thank you. And it's going to play into the politics of this city over the next several months, given the election taking place at year end.
Yeah, it already has. What's the best way to tamp down some of these rents? Is it to have rent control, where one of the mayoral candidates currently has a pad, or is it something like building more? And how do you do that in a way that people can sign off on?
Not a strong argument, is it, when you're sitting in a rent-controlled apartment yourself?
It depends, and I think people are trying to redefine what it means as a middle-class family and what it means to be affordable in this city, and I think that that's an ongoing debate and one that's increasingly fraught with emotion.
It's going to be a massive, massive emotional election in this city later this year. Up next on the programme, the Morning Calls Plus, we'll catch up with Pierre Fargo of New Street Research on Apple's AI push. That conversation just around the corner from New York. You're watching Bloomberg TV.
It feels like a melt-up already. The market figured out and kind of agreed with me that the economy was resilient and we're not going to have a recession. And when it did that, suddenly, boom, we went right back up. So the market ain't cheap. And the reality is if the Fed cuts when there's still, as you said, a lot of ambiguity about whether it really needs a cut, it doesn't really need a 50 basis point cut, let a 25 basis point cut.
But it might get it. Yardeni of Yardeni Research basically said this market might get its cake and be able to eat it too.
Yeah, although it might cause some sort of melt-up that leads to a late 1990s type of situation that tends to lead to a meltdown. So that's the conundrum. At what point is it appropriate stimulation without causing some sort of exuberance that is unwarranted?
He said what Greg Peters of PGIM in the last week said on this program, basically word for word. The experience of last year when they cut rates 100 basis points and rates rose 100 basis points at the long end of the curve. Basically, they reduced interest rates and financial conditions tightened further out along the curve. He's saying you could see a repeat of that, and he's not the only one making that claim.
At this point, how much is that a concern of Fed officials who are raising some alarms about cutting so quickly? We heard Mary Daly talking in a Wall Street Journal interview yesterday that she doesn't see the case for a 50 basis point rate cut next month because ultimately that would send the wrong message to markets and isn't appropriate. The labor market isn't falling off a cliff. This is what we expect to hear more of in the coming weeks.
I think it's a massive disconnect. You've been repeating this for the last several months. It's huge. You're coming out and you're hearing this. I hear this all the time. We need to drop rates to the Federal Reserve. We need to get mortgage rates down. What's the relationship between the two right now? Right now, it might not be that strong. You could come out and cut Fed funds. Let's say you're super aggressive. Come out and say, I think it's a problem. I'm going 50 again, 50 again. You could see this dynamic where the long end of the curve doesn't rally. You're not going to see mortgage rates come down.
This is the reason why we heard Ed Yardeni say that the bond vigilantes were the ones enforcing law and order on the rest of the bond market and stock market, because essentially the sheriffs of the town are going to ultimately set that mortgage rate, which is one of the linchpins of this administration. So you can expect that to be one big focus going forward.
Rick Reeder of BlackRock said recently this is the best time for investing that he's ever seen. I would say something a little bit different. I think it's the most interesting time for investing that I've seen in a long, long time. I find it absolutely fascinating right now.
I completely agree with you, and Rick Reeder might have a very good time investing as Fed chair because evidently he is one of the names
So the same thing.
in the potential list.
Going to try and catch up with Rick soon. Guess what? He thinks we should cut 50 in September.
There you go.
So we'll get his thoughts on that. Let's turn to some morning calls. Our first call from Argus, downgrading eBay to hold, highlighting its rollout of new generative AI models. Our second call from Bank of America, lifting its price target on Cisco to 85, pointing to slightly better than expected results. And finally, Mizuho, raising its price target on Nvidia to 205, saying the company's next-gen CPU is a tailwind into 26. Let's stick with tech. Apple, looking to catch up in the AI race. Sources telling us here at Bloomberg the company plans to launch a slew of smartphone products in the coming years. Pierre Ferragu of New Street has a neutral rating and 220 price target on shares of Apple. Pierre joins us now for more. Pierre, welcome to the program, sir. Let's just start from the top. I just want your high-level views on what's happening at Apple with the shift and the big push into AI. What are they doing? What should they be doing? And ultimately, what aren't they doing?
Yeah, I think they're doing a lot of things, right? It's a very, very long list, and I'd like to highlight like three things they've announced. The first one is they're going to redo Siri. So it's kind of a recognition that like they still struggle to create like a generative AI, very enjoyable voice user interface. They have to rework that. The second thing, so it's kind of an admission that getting into the AI era is difficult for Apple. Then the second one is about all these new devices they're talking about, like having like a tabletop robot, having like home cameras. And the way I read that is, in the last 7 years, Apple increased the average selling price of a phone from about $500 to $1,000. And so they've had like really like an open highway to really increase their share of spending of affluent consumers. And of course, they see the risk. They see the risk that if the smartphone is not the only device, the only personal device in an AI enabled world, they might lose share of wallet. So they need to place bets all around the place. And you know that they did that in the past with a car. They've tried for a decade to launch a car and eventually gave up. And then the last one is, of course, spending on infrastructure. For the first time in a very, very long time, we've heard Apple making comments about CapEx on an earnings call. And so they realize that AI doesn't go by itself. It requires gigantic infrastructure. And it's kind of interesting to see that now maybe AI, like Apple, in a couple of years, is going to be one of the very large spenders on AI infrastructure. We'll have to see how it plays out.
Pierre, there's a lot to unpack there. One of the key points here is this sort of threat, this existential threat to the likes of Apple, that the smartphone is on its way out as the dominant instrument that we all engage with the world with. I mean, this comes at the iPhone's 20th anniversary, which makes me feel very old. I'm just wondering, do you see that as being true, that the new model is going to be something like a tabletop robot or some sort of virtual glasses?
Well, the one thing I can tell you is that the search for the next product is a very, very slow process at Apple. Remember that Apple started working on the iPad maybe 10 years before they produced in large volumes the iPhone. And because they couldn't get the iPad together, they ended up doing a phone. And then once they made a phone in very high volumes, the economics of doing these products changed, and they eventually produced the iPad. So never try to bet, what the next product is going to be based on what's in the pipeline at any point in time. I think Apple's model is we want to do perfect products, and we don't mind working 10 years, 15 years on a product before it gets perfect. And what you've seen lately is the car, the headset, and these products are not working very well. And Apple just keeps going and keeps searching. And I have to admit, Lisa, I don't really have a strong opinion on what the next AI device is going to be, but I share the concern that the potential for the smartphone, and in particular the iPhone, to lose significantly share of wallet is very significant. So Apple has to be very active on that front.
Do you think, Pierre, that the leadership has been good at Apple? This is something we've discussed in this program, calls for maybe some change in leadership, given that the vision has been somewhat lackluster over the past few years, at least in the eyes of markets.
This is a tough question you're asking me, Lisa. So I would say two things. It's very difficult to be in the aftershock of a revolution like the iPhone. The iPhone created a new category. It was like a completely new product category. And of course, it's very, very difficult to be in the aftershock of the founder of Apple and to just be like the enabler, the man who helped make the vision, the product vision, an industrial reality. And so since, Steve Jobs passed away, what we've seen at Apple is a Tim Cook that has kept running the machine beautifully. I don't think you could have done anything better than what he has done in terms of maximizing the value of products, maintaining the very high level of product excellence, etc. But now, does that mean Apple is in a good place? Not necessarily. Apple is at risk of losing share of wallet, at risk of not being able to pull together a proper Siri. And, would have I done better than Tim Cook on this front? Probably not. And I wouldn't blame him. It's just that it's a very fast-moving world, and Apple is $1 trillion market cap in the core of technology, and technology is evolving very fast. So, no matter how good the management is, like Apple is facing challenges today.
They're in a tricky spot, that's for sure, a sticky one. Pierre, appreciate your views. Pierre Ferragu there of New Street Research, the latest on Apple. Dan Ives of Wedbush came on the programme recently and said, BlackBerry moment for this company.
And it comes at a time when there's a lot of competition, and there's a real question about 20 years after the iPhone was created, what is the new smartphone in the 10 years ahead?
You've seen these headlines from the Treasury Secretary.
I do, yes.
Some clarity here, just clarifying. I didn't tell the Fed what to do. I didn't call for the Fed to get to 1.5 percentage points lower on interest rates. It's talking about getting to neutral. To get to neutral, we would need to cut by about 1.5 percentage points. It's not calling for a series of rate cuts. I'm pointing out that models show neutral is lower. So verbatim, this is what the Treasury Secretary said yesterday. If you look at any model, it suggests that we should probably be 150, 175 basis points lower. Also said on September, I think we could go into a series of rate cuts, starting with a 50 basis point rate cut in September. So I'll let you explore the semantics in just a moment. But to be fair, 3% on neutral is basically where the Federal Reserve is at the long-term neutral rate. So 150 basis points south from now. As we've said repeatedly through this morning, what he's saying is not controversial at all. But he's clearly pushing back against how some of this has been framed in the last 24 hours.
This is a semantics point, because he had said originally that he's not going to tell the Fed what to do. And he's saying he didn't tell the Fed what to do. He's just saying that based on his models, neutral rate is about 1.5 percentage points lower than where it is now. And it would make sense to cut by 50 basis points. So parse the language, do what you will. That's sort of the latest today.
I keep saying this. What are we even arguing over?
I have no idea.
Like Federal Reserve's on course to cut twice this year.
Exactly.
And market thinks it goes another 100 basis points next year. Stocks are at all-time highs. Credit spreads are super tight.
Exactly. Crisis.
Apparently. OK, up next, more data. PPI jobless claims just around the corner. We'll catch up with Nela Richardson of ADP. Couple of data points to work through here. So we've got a read on inflation. We'll get that from PPI. Got a read on the labour market. We'll get that from jobless claims. And that data drops in about 15 seconds' time. So going into that data, this is what the price action looks like. So equities just about unchanged all morning. Close to all-time highs. Closed at all-time highs in yesterday's session. Back-to-back record highs on the S&P 500. In the bond market, multi-month lows across the front end of the curve into the belly of the curve. Levels we have not seen going back to April, May time. Yields lower this morning, through much of this morning. 368 on a 2-year. Let's get you some data. Here's a surprise, big upside surprise. PPI. PPI final demand coming in at 0.9%. The expectation in our survey was 0.2. I'll get you a breakdown of PPI in just a moment. I want to turn to jobless claims, because this is the story in the labour market. Claims at 224,000. The estimate was 225. Previous number, a revised 227. So compare and contrast what's happening here in the labour market. That data looks okay. To what's happening with inflation. PPI's just come in much, much stronger than anticipated. Lisa, off the back of that, you're seeing a stronger dollar. I imagine we're seeing an unwind in the bond market a little bit, and we do. Yields up at the front end of the curve by 4 basis points on 2s, up by a single basis point on 10s.
It raises a question, why would the Fed cut rates if they do see signs of inflation? We have to look at the components to understand what goes into core PCE, because that has been a key consideration. Nonetheless, just on the headline level, the fact that ex-food and energy PPI rose 3.7% year over year versus the expectation of 3%. You're seeing that across the board when you look at even ex-food and energy on a month over month, 0.6% versus the expectation of 0.2%. As you were saying, this just raises a question. Have we fully indicated what kind of inflationary impulse there would be from tariffs, given the fact that some of the goods are now coming in with those tariff prices in a way that they could have avoided with pre-orders and inventory maybe a month ago?
Equities pulling back by about 1/3 on the S&P 500 in response to this economic data. Labour market's OK based on jobless claims. We can talk about continuing claims in a moment, but it's really PPI driving this price action. And after 2 days of outperformance on the Russell, what happened? We're down about 1 percentage point at the moment on Russell futures. In the bond market, not seeing a major move. I've got to say that. This is not a big move relative to the rally we've seen at a 2-year. If you think the 2-year's come down by, let's call it 30 basis points over the past few weeks, big move after payrolls, and yet still you get a hot print on PPI. We're only about 3 basis points higher on the session.
So how much is this a market that's looking at potential political influence in the Federal Reserve? How much is this looking at a Fed that is willing to look through any firming up of inflation in the short term? And how much is this specific components? Again, I keep going back to that because the components are important. When I saw the core CPI on Tuesday, I thought, oh, this is a concern. And then you look at the components and they're more volatile, so people could dismiss them. Here, are people able to dismiss it in the same way, or is there something else at play? To your point, John, the fact that you're not seeing that much of a move at the front end, but you're also not seeing that much of a move at the long end, doesn't indicate that this is a market that thinks that this is going to be a protracted inflationary push that's going to really affect the Fed's policy and, frankly, bond policy going forward.
With us around the table, Nela Richardson of ADP, just to break down where we are in the economy. Nela, let's start with not just the data this morning, but the setup at the moment. As you look across your dashboard, what do you see?
Well, what we're seeing is an economy that continues to chug along. Hiring momentum has slowed. I think that's clear. There's been some stasis in the labor market. But overall, when you look at the things that I look at, like, are companies cutting hours? No. Are wages plummeting? No. Actually, they're staying pretty well formed and really, really steady. And so even though we're seeing a slowdown in the momentum, the underpinning of the labor market continues to be solid enough to support consumer spending. Now, we'll get retail sales out in a bit. We'll get some confidence data out in a bit. This inflation surprise is something that should be considered with a whole bunch of other data that was leading up to this point showing no smoking gun when it came to tariffs and inflation. So the big picture is it's an economy that continues to perform. It's just not as dynamic as we're used to seeing.
Ira Jersey of Bloomberg Intelligence is just working through the details of that PPI report. I'm going to cross over to him in just a moment. Just to come to you just quickly on what we're seeing with inflation. Is it too early to draw conclusions here based on the data we've had so far? And will it be too early at Jackson Hole, too early at the next Fed meeting?
Some conclusions are going to have to be drawn because decisions have to be made, but it's really going to be a matter of perspective. So those components, as Lisa mentioned, of the PPI are going to be so important because when we looked at the CPI, the inflation triggers were all in the services. It wasn't like the goods sector was screaming inflation. Those final goods aren't showing it yet, at least yet. Those intermediate goods, the wholesale goods, that's where a tariff could bite in the, as the goods are being built and formed. And we might see that in the wholesale prices and the producer prices an increase. So maybe this is the first sign. Maybe it's just a one-off. We won't know, but we have to look at the complete complexion of the economy. At least some people do, in order to make those rate decisions next month.
We're trying to do that right now. We can do that with Ira Jersey of Bloomberg Intelligence. Ira, you've been looking through the details, sir. What stands out to you? What's behind this big upside surprise this morning?
Yeah, so it's not necessarily the goods sector that's driving a lot of this. So you saw a big increase in the services PPI here with a 1.1% increase month on month. That was negative a little bit last month. So you had this big shift toward services increasing, in particular trade. So some of that could be from import prices. If you think about the pass through from shipping and things like that are going to be goods that are going to be tariffed. So maybe this is suggesting that there might be a little bit of margin contraction, and like you mentioned, not a huge move in the front end of the bond market, but it's still 5 basis points from where we were right before we received the number. I think retail sales tomorrow will wind up probably being even a little bit more important to the bond market than this particular number. But certainly, 50 basis point move in September might be taken off the table with worries about inflation ticking up a little bit here.
It's not just that, Ira, and I'm glad that you broke it down and understood to see that it's coming from services kind of mimics what we saw in the CPI. It's also the initial jobless claims coming in at the somnolent 224,000. Even continuing claims came in a touch. These are the people who keep receiving unemployment benefits. Where is the impetus for the Federal Reserve to need some sort of emergency rate cut, given the fact that this doesn't seem to point to any kind of massive dislocation in the labor market?
Yeah, keep in mind, the claims numbers have been relatively steady for years now, but so remember that's only one side of the equation, right? That's the firing side. So it's really how many new people are entering the workforce and are going to be then hired by firms too, because at this kind of pace, you'd wind up with pretty massive layoffs actually if there's not someone hired on the other side of those initial jobless claims. And you have seen a slowing in that. So it has to be the job market, right? The Fed to cut more than 25 basis points in September would require a really disastrous kind of non-farm payroll number, I think. Now, that being said, just the slowdown in the hiring process without consumer prices ticking up quite a lot, that could mean that, hey, the Fed could ease just a little bit to kind of placate the market, make sure that the job market doesn't completely fall out of bed. And I suspect that that's the thinking of those members like, Governor Wallers and Bowman, who have seen this slowing in the job market and are concerned that it could get worse. So let's be a little bit proactive here. Now, that being said, do they have to do that? I don't think so. Like we had always had penciled in based on our forecasts in October as the first rate cut. But realistically, September versus October, it's not going to matter that much to 10-year Treasury yields, quite frankly.
Ira, just before you go, I've just got a brief question, and it's to build on what Lisa and I were talking about at the front end of the curve. Why is this market looking through firmer services inflation, both in CPI and PPI this morning? Why are we only up by a basis point or two? If you told me these numbers earlier on this morning, I might have guessed, might be up double figures, double figure basis points off this, maybe up 10 basis points, 11, I don't know, but not a single basis point.
Yeah, well, I think that the CPI report wasn't nearly as bad as I think the market thought, and the market is certainly pricing in for a modest easing of monetary policy over the next couple of quarters, and and again, like as long as you wind up having a slowdown in the economy, the Fed is going to try to right-size things. And there is this idea that within the market, and I've talked to a lot of market participants about this, where is neutral, right? I actually think we're pretty close to the neutral rate, but a lot of people disagree with me and believe that the neutral rate is closer to 2 or 2.5, which is where headline inflation more or less is right now on a CPI basis. So people do think that rates are still restrictive. Again, I'm not as convinced of that, but that's where the market is, and that's why the market thinks that the Fed is going to be cutting rates in the very near future.
Don't fight the market. It's always the lesson. Ira, thank you, sir. Ira Jersey there of Bloomberg Intelligence breaking this down. Lisa, services again. Firmer.
This isn't necessarily a good thing for the Federal Reserve because typically services is something that's more discretionary and tends to be more fungible. It raises this question about where the weakness is coming from. Nela, I have to say the ADP report's taken on a lot more import recently, especially with some of the questions around the BLS. And I just wonder what kind of hiring you see in services and wage increases to edify the sense that that's an area that's actually been benefiting of late.
I think the issue with the labor market is that the structural and the cyclical are kind of colliding in this moment because we are still in a labor market that's being impacted by the pandemic. We're being impacted by an aging workforce. We're still being impacted by the Great Resignation, which means the turnover, that dynamism is missing in today's labor market. So when you look at something like services, what are you seeing? Well, first of all, you're seeing certain pockets of services slow down tremendously. We saw a dip over the summer. It's rebounded, according to our data, in the last month. New entrants into this market is very slow. If you talk to any parent of a college-age student, it is, my student is still looking for a job, even though they just graduated. If you look at ADP data, if you don't like the anecdotal, you want to look at the hard data, we pay over 25 million workers in the United States. And what we're seeing is that new higher pay hasn't budged from $18 an hour for the median in more than 13 months. So there is a stagnant part of this labor market when it comes to onboarding new people. That's going to be reflected in productivity numbers, and it really is going to impact services more than goods. Goods sector, that talent tends to be more specialized, fewer new hires, less affected by the people dynamics that underpin the labor market.
Can I ask you a provocative question? Is the new BLS chief good for business? Which I think is what Lisa was trying to ask. Is the new BLS chief good for business over at ADP?
Well, until they're confirmed, we won't know. But what I can tell you what's good for business is good data.
Nela Richardson of ADP.
Very diplomatic.
Thank you. I expected it to be diplomatic.
It was very well done.
That was basically what you were getting at.
Well, it's just,
We'll be looking to ADP a little bit more, right?
I mean, that's what people are saying, is that ADP is going to matter that much more because it isn't changing its methodology in any capacity, and there are increasing questions around BLS.
Stocks are down. We're down by about 0.4% on the S&P. Not trying to get anyone in trouble. The Nasdaq 100 is down by about 0.5%. Big move lower on the Russell. We're down by 1.3. Again, just to go back to the bond market, so big upside surprise on PPI, and yet bond yields are higher by just 2 basis points at the front end of the curve. Ira Jersey said it, don't fight the market. This is the market pricing in cuts one way. We're moving lower. That's the view of the market at the moment.
And it seems like Fed officials are on board with that. When you look at the components, though, I don't understand how we're looking through services inflation to such a great degree, especially if it is edified. It really puts more import on tomorrow's retail sales. If you see the strength that Aditya Bhave of Bank of America was talking about that they're seeing in their Bank of America survey, do you get the same sort of confidence that this is really just a one-time kind of head fake and that the labor market report really was the real story?
We've said it on repeat, and I know it's a bit of a cop-out, but it's just how we feel. Jury's still out. Got to wait for the data, and it's so hard to draw conclusions about where we are.
Anyone who says that they know the answer to that, I would like to see what they eat at night. But, I think a lot of people would agree.
Let's get you an update on stories elsewhere. You were thinking of something different. I know you were. OK. All right. Let's get your Bloomberg brief with Yahara Anand. Hey, Yahara.
Hi, John. Recapping the latest economic data, July PPI coming in hotter than expected at 0.9%, way above estimates for an increase of 0.2%. Core PPI also coming in well above expectations. Meanwhile, 224,000 people filing for jobless claims benefits in the week ending August 9th. That's just 1,000 less than estimates. Meanwhile, on to Russia as President Trump prepares to meet with Putin tomorrow. Trump warning he would impose very severe consequences if the Russian president does not agree to a ceasefire with Ukraine. He said he hoped to use the meeting in Alaska to set up a quick second meeting with both Putin and Ukrainian President Volodymyr Zelensky. And Amazon plans to offer same-day grocery delivery in 2,300 cities by the end of the year, more than doubling the current number. It says customers will be able to order perishable items alongside frozen foods and household goods. The same-day grocery delivery service will be free in most cities for Amazon Prime subscribers on orders over $25. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead and the rest of the week going into the weekend. Plus, we'll speak to Scott Chronert of Citi after lifting his year-end price target for the S&P 500. All of that still to come. Live from New York, this is Bloomberg.
There doesn't need to be a huge pickup in inflation, but the point that we've been making is that even X of the tariff shock, the core PCE, headline PCE, probably stuck around 2.5%. And that's the concern that we have for Fed policy. We think they're meaningfully away from target and even further away in the other direction than they were before the pandemic. We're being hit by so many supply shocks right now that it makes forecasting very difficult.
That was Aditya Bhave of Bank of America weighing in on the inflation data and the labour market data as well. He still believes this Fed won't be cutting interest rates through the rest of 2025. PPI just moments ago coming in firmer than expected. The pass-through to PCE, though, may be fairly limited and unchanged in the minds of a lot of people on Wall Street, yet still equities down by 0.4% on the S&P and bond yields that little bit higher at the front end of the curve.
Looking at the breakdown right now, what stands out to me is we're paying more for our bundling. When people want entertainment, all of those price increases from Disney and Hulu and Paramount, that's going into cable satellite subscriber services and wireless telecommunication services, bundled wire telecommunication services, all going up significantly. And I wonder, this speaks to the moment we're in.
Bills are getting more expensive.
Yeah, and it just...
I love that rant.
I think that this basically is the embodiment of that rant, is that is single-handedly, it's not single-handedly at all, but it's part of the reason why.
Go after them. You've got some more time. Just keep going.
Look, to me, I think that it's notable to mention that 4.2% of an increase in costs for cable satellite subscriber services. I think that's important to point out.
I'm on board. Let's get those prices down. Hulu.
Yeah, it's like the sports. Well, you're annoyed about the sport.
Every time I get that email from Hulu and it's like, it's gone up again.
But you pay it.
Yeah, unfortunately,
yes, here we go. And that's factoring into this.
Stocks are down this morning on the S&P, retreating following that PPI print. With your movers, your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. Here's one of the companies that's eating higher costs. It is Tapestry, and shares plunging in the pre-market, down 12%. Their outlook incorporated a new tariff hit that appears to be about 60 cents eating into their EPS. And with that new information, the market incorporating that into the price with a weaker outlook of about 4% growth for their fiscal year. Meanwhile, Deere also under pressure. It's both supply and demand. A record corn harvest plus demand looking a little bit more sketchy with some of the tariff and trade concerns seeping in. So they cut their outlook, shares down 6%, more than that this morning. Meanwhile, space companies getting a lift. They were getting a lift, but just in a sign of how much that PPI number changed things around. Trump had signed an executive order allowing them to make it easier to launch rockets. All of these were up about 2%. Post PPI report, they are down at least 0.33%. John.
Danny, thank you. Appreciate it. Thanks for the update and the market reaction there. Just the day ahead for you, going into the weekend at 1 p.m. Eastern Time. President Trump delivers remarks into tomorrow, Friday. The President of the United States and the Russian President, Vladimir Putin, meeting in Alaska. Plus, retail sales and new consumer sentiment. If you want a sneak peek of next week, Tuesday, Home Depot earnings. Wednesday, Fed minutes plus results from Target. Thursday, Walmart results. And then we've got Jackson Hole. In Jackson Hole, Wyoming, the Federal Reserve annual get-together. Retail in focus, though. Big one going into that.
Does it edify this sense of strength that we've seen currently, at least in PPI, with travel and entertainment taking such a big portion of some of that increase?
I'm pleased to say we've got some time now to break down a recent call from Citigroup and Scott Chronert. Bullish on the S&P 500, raising his price target to 6,600. Scott joins us now for more. Scott, welcome to the program, sir. Great to get a few minutes with you. Just walk us through what's behind the upgrade over the past week, particularly when it follows that dreadful payrolls print from a few Fridays ago.
Yeah, Jonathan, great seeing you. Hi, Lisa, as well. So look, I think it's about fundamentals and earnings, right? So what we've been navigating for several months now has been, things such as tariff concerns, ongoing concern regarding the state of the consumer. We can perhaps come back to that in terms of services versus goods. But all told, what's unfolded here is that we went into the Q2 reporting period with an expectation that, we'd see a normal positive surprise. And we got a little bit more than that. What we got also was a little bit more confidence that the worst case around tariffs is probably mostly behind us at this point. And going forward, it does look, in our opinion, that some of the tax reform measures of the recent budget bill will play through in a positive sense. So generally speaking, what we're looking at here is a really, really solid earnings backdrop for the S&P 500 that we think persists in the back half of the year and has legs to run into 2026 as well.
Scott, your bull case is 7,200. What would you have to see to make that your base case?
Yeah, so Lisa, this is where we're going to get back to the topic du jour in terms of where the Fed's living here. So what I would say is that when you look at the setup right now, our work is that literally half of the S&P market cap is associated with this AI influence. Okay, you have the other half though that's going to be more traditionally economic sensitive, and where a lot of the metrics that we're discussing today are going to come into play. To get to that 7,200, what you need is a massive Goldilocks environment where you have ongoing persistence in economic activity, an okay labor market, the Fed in position to ease because inflation's coming down, right? And that, I think, is the bull case for U.S. equities. Some of it has begun to get priced in. I think that's what we're looking at with the more recent move in U.S. equities. But to get to that massive melt-up mode, that's, in our view, where you have to get.
Scott, a lot of people are saying things like, I'm seeing complacency. I'm worried about narrow breadth and concentration. Scott, we've heard those worries for the last decade or so. Are they valid this time around?
We always get concerned. Like we pointed out in our recent note that our sentiment index, the Levkovich index, is clearly in euphoria, and so we have to be attuned to that. What we pointed out, though, and this is, I think, the topic du jour on this notion of where sentiment lives, is that historically, when you're in these euphoric readings, you tend to see a bigger volatility impact. So as we go forward from here, given where valuations are, given where a lot of the noise around Fed trajectory and other policy measures are, you need to see this, as I kind of mentioned, threading the needle dynamic. But what ends up happening is that anything that appears to distort that, which may be the PPI data today, is going to trigger that bit of volatility response. We're going to fall back and say, got it, understand. There are going to be areas here where we have to be paying attention from a macro perspective. But again, I'm going to fall back on the fundamental trajectory here is where we're going to really use as our guiding light. And I think the setup is increasingly constructive for the big chunk of the S&P 500 in particular.
Scott, appreciate it. Thanks for the update. Thanks for jumping on before the opening bell. Scott Chronert there of Citi. That opening bell about 35 minutes away. Pulling back from all-time highs in the equity market. Having a rethink about inflation in America. I imagine we'll have a few rethinks going into that Federal Reserve meeting about a month or so away. Live from New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Day 7 at the Cincinnati Open. World number 1 Jannik Sinner had to beat the rain and Adrian Mannarino to punch his ticket into his 5th quarterfinal of the season. The defending champion closing out the win in the second set breaker after just under 2 hours on court. And don't forget, you can watch all the action live daily on Tennis Channel.